And we are back. And no, your eyes do not deceive you. This is a whole other cast. It's a whole other day. It's a whole other show. It's still called Overtime, though. I'm Ilias Pivac in San Francisco. That's Thomas Westwater, sorry, Thomas, and Mike Butler there in Chicago, with a very special view on what's going to happen in these markets now that today has passed and given us all kinds of confusing things. Gentlemen, how goes it?
It's going well. Markets are just churning, it feels like. But it's delivering us into the weekend. So who are we to complain?
Help me to understand what happened here today, because as macro nerds go, I was reading the slew of economic data that came out today, and there was a lot that there was to chew on here. What stood out to you guys, and why do you think the markets ultimately didn't care about this flood of information?
I think
at least as far as stocks go, I should say.
So the retail sales came in, they were light. It affected the market a bit. You also had the PPI in there, the home sales were weak. But I think this was something that was already priced in. We knew that the impact of tariffs was going to have some effect on consumer spending. We saw imports get pulled forward, and then we get this retail sales data. It's slightly soft, so that's reflecting the consumer more than manufacturers. So you're seeing that, consumers are a little weary to spend right now. But I think that the market is expecting these talks to go well, that we're on a path of resolution now, and that now in the future, the expectations are that this spending is going to return. We're going to get some uplift in the economy, pending that these talks go well. We have the 90-day pause on the China-U.S. tariffs, the rate's down to 10%, whatever it is from China, 30%, something like that. So I think the market is still looking for optimism where it can. And absent a negative headline outside of economic data, if we get a headline that says, trade talks deteriorate, China, tells the U.S. to go, walk off into the woods, then it would impact the market more. But I'm putting walk off into the woods. There's other phrases you could say, but I think that's what's going on.
Walk off into the woods is a new one that I've heard.
Yeah,
but it
I like it.
It gets the point across. As
I was sitting there waiting for where Thomas was going to go with that, I'm like, okay, this is going to be poetic, and it did not disappoint. Well played.
We want the FTC on us.
That's right. This is sort of where this becomes very interesting for me, because if you look at where we're sitting as far as the S&P here as just a kind of barometer of overall risk sentiment, this is the direct underside of this range where we were consolidating going into the beginning of the year and sort of waiting for what the policy wins would ultimately give us. Obviously, we did not freak out back here when the election actually occurs around the idea that there's tariffs and there's this and there's that. The markets don't actually freak out on that then, ostensibly because they go, you know what? Conceptually, this isn't scary. Let's see what it looks like in practice. And then in practice is where we see the growth fears begin to emerge. Here, this is as the business confidence and consumer confidence data starts to roll off negative. Then, of course, we have whatever last month was, this kind of idea that in the U.S., we're going to do our absolute utmost to cut our nose off and to spite our face and basically attempt to extricate dollars and treasuries out of the foundation of the global financial system. So sort of like dig a tunnel for the foundation of the house to leave and leave everything else just hoping to stand. Obviously, that freak out has now passed, but we are basically back to the starting line here, where the demarcation point is for we're afraid about growth or we're not afraid about growth. So it's a very interesting spot. And the thing that jumped out at me today was this move in the bonds. And this was across the curve today. I mean, obviously we're looking at ZB here, but ZN rallied, ZT rallied, interest rates were lower across the board. Does that tell you anything here?
I think, the PPI data, the retail sales data, it boosted the Fed cut bets a little bit. If you're looking at market trackers like the countdown to FOMC. So a slight, strengthening in rate cut bets, pushing yields down. The move in yields is a little more than I would expect, just on that data alone. So I don't think that fully explains it. I'm not sure what exactly is happening there, but a pretty significant move in yields today.
Yeah. So as I was reading this data and sort of trying to figure out what happened, and Mike, I'd love to hear what you're seeing here from your vantage point. But the thing that jumped out at me was that you had this massive move lower in yields. I mean, we can see it here, and we can see how it happens basically in line with where this data starts to occur. The data appears right around here. The markets take a little bit of a second to digest it, and then yields go screaming lower and bonds go up. So the interesting part of this was that Fed policy odds in their aggregate, so this year and next, actually came in a little. But how much easing was priced in for this year increased. So the market's really cemented around 50 basis points for this year, which they weren't quite so sure about yesterday, but they wound back a little bit from next year, which is interesting. Now we're only looking at 30 basis points for next year instead of another full 50. So it's a curious sort of mix where the markets seem to go, they'll need to cut sooner, but maybe not so much. Powell also spoke today, and it wasn't really a policy speech. It was more like academic, long-form thinking, but they're revising their framework, and they'll have a new one for next year, ostensibly, and by the end of the year, we'll know what the update is. But the progress report was they're probably going to jettison average inflation targeting. So this idea that they came up with 5 years ago that they're going to allow for inflation to overshoot or undershoot if it is following a period of the opposite. So if inflation is structurally too low for a long time relative to target, they'll let it overshoot for a while. And if it's too high, they'll let it undershoot for a while. They seem to be saying policy is going to have to be more reactive and more fast acting. And we're not going to tolerate deviations as much. We're walking that idea back. So they're seemingly setting themselves up for a situation where they're not going to perhaps cut as quickly if inflation is sticky here. And so despite all of that, yields come in sharply, and Fed policy odds move to sooner cuts, not later. So I thought that was a bit curious.
Yeah, I think
Mike, what are you seeing out here?
Yeah, it's interesting when you have first of all, the E-mini S&P futures have gone up every day except for 3 days since April 22nd, almost a month straight of just green bars. And yeah, there is still a lot of uncertainty under the hood like we're talking about, but I've been keeping my eye on the FedWatch tool, and almost exactly like you said, 2 weeks ago through the December decision, there was a 75 basis point cut priced in. Now they've taken that out and they've moved it to a 50 basis point cut being priced in by a much larger probability. It was 30%, 30%. Now it's almost 40% for a 50 basis point and 30% for 75 basis point. But to your point, the June decision was significantly higher of a percentage to stay where we're at 425, 450. And now they're pricing in a larger probability of getting a 25 basis point cut in June. But if that doesn't happen, it's much more probable that we get that 25 basis point cut in September. So literally, like you said, the probabilities have shifted almost exactly to your point. And I think that's why you're seeing a recovery in the E-minis, which I feel like is natural given the decisions and the discussions that are being had. But there is still plenty of volatility in the interest rate environment.
It's an interesting thing because, and I'm going to nerd out here for a second, so apologies ahead of time. But if you look at the internals of these reports today, let's take retail sales first. Obviously, people were expecting a slowdown. They were expecting a flat number. They got 0.1%. So at face value, it was even a little bit better than expected. But the real interesting thing is what happens from March to April. In March, we had this giant revised 1.7% surge, which is a lot for a given month. And when you look at what happened there, it was almost completely driven by an almost 5% rise in motor vehicles and auto parts. And of course, it lines up with when those tariffs come out. So you get the sense that consumers are trying to front run the auto tariffs, basically buy as much as they can before those happen. But what do we have in April? We have Liberation Day. Everybody freaks out. Then a few days later, the president says, well, good news. Here's a 90-day front-loading window before the worst of this goes into effect. So you'd think consumers that were minded to front-run tariffs would front-run tariffs because they were just spooked with these large numbers, and now they've been given a mulligan, essentially, to say, go buy stuff that's not so expensive. Here's a 90-day window because now you know what's coming. Okay. They don't front load, though. Retail sales don't go up. So what's going on with consumers here? Okay, let's take that thought and take it over to the PPI report. Here, we have the first month-on-month decline in wholesale inflation in a few years, and the largest one since COVID. So you go, okay, what's going on here? And it's not the goods side. It's not like the price of goods fell. Obviously, with tariffs, you wouldn't expect that. It didn't rise a lot either, so perhaps that's still in the pipeline. But the real story was the decline on the services side of inflation because margins shrank by 1.6% for costs related to basically running the supply chain. So costs of shipping, cost of warehousing, cost of getting things from port to store, essentially. And that tells you that businesses are eating rising input costs. They're not passing them on to consumers, which helps to explain the relatively normal CPI report earlier this week, and also seems to suggest, well, if consumers are being insulated, why in the world aren't they stockpiling and front running since they know what's coming? So it paints you a story of consumers that are reluctant and could be more so were businesses not shielding them. And it also makes you think that all of the import surge and inventory build in the first quarter GDP numbers, which obviously skewed that report a lot, that might be stuff that sits in warehouses if consumers don't want to buy it. And then it's going to end up looking like a bad investment. So in a year when everybody has to roll over their 5-year COVID money that they borrowed at zero and now have to refi basically this year and next. So you crown all of this off with jobless claims numbers that give you the highest 4-week average since October. And you go, okay, wait. So companies that are eating input costs instead of passing them on to consumers, they're probably not going to be enthusiastic about hiring. And then consumers don't get the hiring, so they don't consume. And if they don't consume, then you need to eat their costs more. And you get a kind of vicious spiral here. So you already got the weakest contribution from household consumption in almost 2 years in the first quarter. What happens when that occurs in the second quarter? Or worse, let's say. So that's where my head is going here. And obviously, stock markets don't really care because it seems like they embrace this idea that sooner rate cuts are coming and maybe there's a kind of balance there. But bond market seems to have gotten a little bit of energy behind it, thinking, there's something that's brewing sooner than we thought. The Fed's going to need to wake up here.
Yeah, I mean, I think those are all good points. And if you're a retailer or business and you expect the tariffs to be short-lived, you don't want to raise your prices because all you're going to do is lose market share. So if you stomach it for a while, you eat those margin costs for a little bit, and you expect the tariffs to be, taken off, you're going to do that. But at the same time, consumers are pulling back on their spending, so that hurts the margins even more. So if the tariffs go awry with these talks and they go on longer than, say, the 90-day pause, then I think you could bring the recession fears back onto the table. I think right now what investors are expecting is just some moderation in growth, a little bit of sluggish growth for 2, maybe 3 quarters, and then we get back on track. I think with the market being forward-looking, it's why sell here, especially if the Fed is going to come in and gently cut rates, get us back on path, trade gets back on path, everything like that. And then all of a sudden, you're past the rain clouds that have formed. So I think it makes sense that, we're still moving higher. The economic data definitely hit the markets early in the day, but you saw it was digested quite well. There was obviously no shock to the market. For the bond market, that's my thing too. That's why I'm wondering why yields have dropped so much. And it's also another thing you have to bring up is Congress is going through another tax bill right now. So bond traders are watching how that's developing quite closely. Now, if you do tax cuts and you have no way to pay for them, if you're not the U.S., that's led to catastrophe before. We look at 2 years ago in the United Kingdom, Liz Truss, the whole lettuce thing.
The lettuce thing.
Yeah. Earlier this year, you had people calling for, the de-dollarization is finally here. The global regime is changing. But, it looks like this tax plan is going to move forward with tax cuts without, subsequent one-for-one funding. I think that's pretty positive thing for the bond market. It shows you, pretty objectively that we are not actually at that point where you are getting, this shift away from the U.S. as an actual safe haven. So I think that's pretty notable there. I'm not sure it explains the move today, but that's just something to consider in the backdrop.
Mm-hmm.
Yeah, and I think when you look at the cyclicality of the E-minis and NASDAQ, like any kind of equity space, obviously markets are moving way faster than they did many years ago. So you're going to have these kind of knee-jerk reactions to the downside and in recovery mode to the upside. It is still surprising to me that we've recovered this much. I would have been less surprised if we kind of chopped around that 5,500, 5,600 level. But we could easily get back there if something comes off the table like we're talking about. So from a tradability standpoint, there's still plenty of products out there that have been beaten up that if you wanted to buy and get long, you could at much lower levels. But from a downside perspective, volatility is as low as it's been in the past couple of months. We went from backwardation to contango. There's over a point of contango now between the K and M contract. So if you're looking for near-term hedges or even just hedges in the equity markets to play for something falling out of it from a relationship or talk standpoint, it's now cheaper than ever to do that as well. So it's very tradable still. We've had this period of calm the last couple of days, but even though volatility is back in the teens, I think you'll still get some spikes in volatility. You'll still see two-sided action because let's not forget what we're dealing with. We're dealing with very volatile situations where things can fall out of bed very quickly. And if they do, the markets are going to react that way. But right now, to Thomas's point and yours too, Ilya, it's like there's still some churn that seems like it's baked in going forward. we're getting a better picture of the interest rate environment with more probabilistic outcomes from what I've seen. Because literally the last couple months through this, it's been really baseline. If you look further out on the curve through the end of the year, it's like we might be at 75, we might be at 50, we might be at 25. Now it's starting to form this narrative of we're probably going to be at this point, and it's growing in probability, which speaks to the bonds and rates. But from a tradability standpoint, you can still do a lot of things here, even if you don't believe that the equity market's going to sustain. You now have a very cheap way to play to the downside at higher prices.
Yeah, that is certainly it. If you want to take the kind of exposure, which admittedly I took way too early, and just straight up buy put verticals, it is the cheapest that it's been. Certainly in sort of the recent weeks.
Yeah, and why not do that at least as part of your portfolio? So when you do get those red days, you're at least insulated. Even if you're playing a bullish thesis, you have a hedge in there, here and there, and you can do that tactically.
I mean, absolutely.
But you look at the
things like SPY, things like the Qs, things like IWM. Although that one's a little bit thinner, they give you smaller sizes and cheaper costs than, let's say, even MES or MNQ. So you could find some very cheap hedging opportunities here. To your point, Thomas.
Yeah, and I think IWM is probably one of the better ones to do it on, because if you get these trade fears coming back into the market, it's the smaller companies that don't have these margins to outlast a prolonged trade war. So I think it's a really smart move to play if you are doing those, buying put spreads, especially as a hedge against a more bullish portfolio, to do that on IWM.
One thing to keep in mind about IWM that I learned recently is to just stick to the tasty methodology and roll over your positions once you get to let's say 20-21 days to expiration, because liquidity starts to really dry up as you get closer to expiration. For example, I have a part of my vertical that I was trying to roll with about 5 days left, and for some of it there was just no bid, and so now it's just a thing that sits. And I mean, obviously you can essentially assume it's going to expire, worthless trade around it if you have capital to just sort of put on what you want to have on, and then let that thing just kind of sit in inventory and fall away. But if you don't have that kind of capital, or if you've committed it elsewhere, it can hamper you a little bit if you start to kind of press it closer to expiration, because liquidity in this thing is a little bit thinner than, let's say, SPY.
Yeah, and one other thing in the market today, we had a big move down in crude oil.
What a segue, Thomas. I was just about to ask you.
Yeah, so I mean, this one's interesting because you have the U.S.-Iran talks going on, which the market is really focused on. Trump just had a visit to the Middle East. There's a lot of players on the table mediating these negotiations now. Iran's producing around 3.1 to 3.5 million barrels per day, depending on the source you look at. The interesting thing is they really don't have that much capacity to increase production more in the short run if these tariffs are lifted. So I'm wondering if the market is overconfident in how this will actually affect the global supply of crude oil. That being said, now you have OPEC very inclined to keep on rolling back these voluntary production cuts. You could say they're doing it for multiple reasons. Better U.S. relations with the U.S. right now, try to punish U.S. producers, get Kazakhstan and Russia, Iraq back into, enforcing their quotas. They do it through that. They've done it before that way. So there's multiple reasons. Another reason is they just want to eat the pain right now and finally take these voluntary rollbacks off the table. It has to be done at some point. Why not now? That's probably just as viable of a reason as any other reason. But the fact is, they're doing it. They're going to, from all signs, it looks like they're going to continue to do it right now, out into June, July, August, most likely. So oil trading just above 61 right now. We got back above near the 64 mark. We were all the way down as far as 55 just earlier this month. So, you've had a good amount of volatility in the oil market. I churned my position into pretty much an iron condor today. I'm 56, 58, and 63, 5, 64 at 32 days out. It's getting to the point where I'm going to take it off soon. I'm going to give it another week, see how I think we're getting to the point in these negotiations where you're going to get more material substance over the next week. And while I said that it probably ultimately doesn't impact the oil market that much right now, it seems like that's what the market is focused on, is these negotiations. So I don't know. You also had the EIA. They reported a surprise withdrawal in inventory, or build in inventories yesterday. So, we have supply building. You have crack spreads that are still strong. You have refinery utilization rates that are strong, but not as high as where they've been. So refiners seem reluctant to pull back on moving crude oil through right now, even with some fear among traders. They're still moving the oil into products. So it still seems like the oil market is going to remain somewhat strong over the short term. What does that mean in terms of trading? I think we remain above 60 for a bit. I don't know if we get back into the 70s necessarily. I think a lot of this economic moderation is going to kind of kneecap that, along with more OPEC supply. So I think you get to these points where you take advantage of the volatility, you try to pick a range, and whether that's selling a put spread, selling a call spread, if you think that range isn't going to be broken, or putting on an iron condor if you're more confident in that. I think that's probably the way to play it right now. And if you look at the technicals, you have pretty good levels to carve out, technical ranges that you can trade around.
Yeah, crude has been a darling for many years. We've talked about this before, but it's nice when you have a product that is truly a two-sided vehicle, where you have shifts higher, you have shifts lower immediately after. And we've seen that from the beginning of April. We've had a range between 65 and 55, 10-point range, both sides. If you were short, you had opportunities to get out. If you were long, you had opportunities to get out. So we're almost always in crude, micro crude specifically. For me, I like just buying the contract straight up. I have a covered call on right now with the long contract and a short call at 65. So kind of just taking advantage of the IV in that range and seeing if we get a bounce here. But yeah, it's been a great trading vehicle, especially the micro, where you can get much smaller than the bigger contract.
It's an interesting thing because technically you look at this and you go, okay, so you have a situation obviously where OPEC starts to give you this idea, we're going to get rid of these voluntary output cuts, we're going to boost production. And Thomas, obviously, what you're describing here is exactly it. They want this friendly relationship with the U.S. They obviously understand that the administration has a different perspective now. The president is in fact there currently, and so you have this sense that, okay, this is the time to do this. If ever we could negotiate for a security blanket, especially if you're Saudi, this is it. And so you have that gap, and then the market goes, yeah, but you guys never follow through. You guys never manage to have the kind of discipline that you need to get your membership to actually meet output quotas. In fact, these guys haven't met their output quota since they developed output quotas in 2014 for the whole outfit, the OPEC plus outfit. So the cartel and its friends, as it were. So the market looks at this and goes, yeah, okay, right, sure, whatever. And then oil goes up and runs into this 64 level, which we can see is a very clear kind of middle axis in whatever this range is, from 71 to on the top side to like 54 and change, 55 on the bottom. So we come off there, and the thing that grabbed my attention today was, if you look at, I have an 8-hour chart here. If you look at the sort of architecture of this rise, right? Higher high, higher high, higher low, uptrend classics. You break through it right here. Now, it's very preliminary, very kind of early to say, and I didn't act on it today, but it gives you the sense that maybe you're in for what is the next oscillation in this. And directionally, it's not the greatest at 48 IV to be buying put verticals, but it's also not very expensive, especially if you look at something like, let's say, USO, which is very, very cheap. So when you look at this and you go, well, are we going to get maybe a wiggle in this direction now? Maybe around some of these negotiations that are taking place in the Middle East. Maybe the headlines give you enough. It's still probably going to be something that's going to have to be a real commitment from Saudi by themselves, maybe with some assorted help from the Emirates, maybe some other like very Saudi close places where there could be consensus. I guess you could also, Thomas, to your point, get some sort of an Iran walk back and some of that supply coming back on. Would it matter? Probably not. But it could give you a shorter term wiggle within this range. Do I think that's going to give you a breakdown lower? For all the reasons that you've just outlined, Thomas, probably not. But headline-wise, there could be not so much an investment, not so much a set it and forget it kind of a thing, but maybe just a trade to look back toward the downside. And the kind of signs of weakening consumption that we saw earlier today, they sort of comport if that becomes the focus, because we have consumer confidence numbers that are coming out here to kind of finish the data outlay for the week. And they're expected to be absolutely awful. They've been absolutely awful, and they're expected to stay absolutely awful. The inflation expectation component has been the main reason, obviously, around the tariff fears. 6.5% was the one-year inflation expectation in the last version of this report for April, and now we're going to get the kind of first look at the May edition. If everything that we're seeing in the PPI today, the retail sales today, if all of that gives you a defensive consumer, and you know you already had a defensive consumer in the first quarter, now it starts to look like you're getting a defensive consumer into the second quarter. And the consumer confidence data would give you the first kind of real look at May, sort of as it's happening. Then you'll get the PMIs later, and sort of the picture will start to crystallize. By the way, the latest PMI numbers, absolutely awful, showing the U.S. economy is basically stopped. It's basically at a standstill. Like once you peel away all of the distortions from imports and inventory building, actual new economic activity, whether you look at the ISM or S&P Global, has basically stalled. And obviously the big question is, now that you've had a 90-day kicking of the can on both the reciprocal tariffs and the China tariffs, so now you have cliffhangers in July and August, you'd think, okay, well, probably you get more front running because businesses just got another window to do what they did in the first quarter. But then if consumers don't buy it, this imbalance starts to get exacerbated. And now you're really setting yourself up for recession classic. Overcapacity, disinflation, discounting, job losses, falling consumption, sort of very, very kind of regular business cycle stuff. Not a crisis, not anything spooky like '08 or COVID or anything like this. Just a regular old recession. And of course, the trouble with those things is that those things are non-linear. You never quite know what a recession might kick up, because as long as there's growth, you paper over all kinds of things. If people are confident that there's money to make tomorrow, though you might have lost it today, things are going to be okay. Confidence will hold up. But if they're not, if the growth part of the story falls away, well, then maybe tomorrow money isn't on the table as readily and things get defensive. What's interesting about crude oil in this context is you get some chatter about maybe increased supply, and maybe the markets even believe it for a while. If you then with that get a growth spook, this could be telling you that crude is at the very least interested in revisiting the bottom of this range before maybe whatever else. And I'm curious how all of this comports for you guys when you think of the dollar, because this thing has been very weird. If you look at the overall index here, obviously it's not really going anywhere. But if you start to pull apart the internals, say you look at the euro, and you can see here the euro really doesn't do much of anything here the past several days. But if you look at the yen, which is a much more bonds kind of facing thing, as bonds start to go up and as yields come in, so too does the yen. It starts to go higher, which again is sort of recession-y in its look. Last thing I'll say here, and I'm curious to your thoughts, the sectoral breakdown today, very interesting. The only S&P 500 sector that is down today is, drumroll, consumer discretionary, which really fits into what we're talking about here. Consumer staples, on the other hand, up, which is defensive. Utilities up. Real estate up because ostensibly lower rates and rate cuts are maybe finally going to help unlock the housing market. But the only red on the board today, consumer discretionary. Thoughts?
I think Tesla hit the discretionaries today. I'm not sure if Tesla was the cause or just got dragged into it, but it's heavyweight on discretionaries. I think, yeah, it's with the margins and the PPI data, retail sales showing that there's less spending. So if you're a consumer and you're trying to tighten up your balance sheet for your household, you are pulling back on that discretionary spending. You consumers, the staples have to stay strong because they're staples. You have to have them. I mean, I don't think it gets more complex than that, really. I think that's a simple explanation.
Yeah.
That's
trying to tell me people aren't going nuts buying Royal Caribbean cruise tickets right now?
I mean, if you look at the data if you look into the data this morning, hotels and flights were actually really weak. Yeah.
Yeah.
I mean,
yeah.
It's maybe a good time to bargain hunt on those getaways.
Yeah. I mean, I can see it. It makes sense that people would be weary after enduring what we just endured, right? It's kind of like everybody got the shock and the big move down in the equity markets that most people are passively long. If you have any kind of retirement account, you're likely affected by that. And now you are kind of maybe a little freaked out. You want to wait and see, take the wait and see approach versus just diving in head first. Makes total sense. I would be remiss if we didn't talk about gold, though, on behalf of Chris Vecchio.
we do have to talk about gold.
Because this is a big intraday move today too.
And it does have to be on behalf of Chris Vecchio, because I ran away from my long position earlier this week as we broke down this this band right here. So I essentially jumped on right around here, basically on the same logic that Chris had, that this was this, and that you're just stair-stepping up. So you had a rally. Here was your level. You rallied. You corrected. Stair-step, higher. Pullback, stair-step, higher. It worked for a hot 2 days here. And once it took out the stair-step back on the downside, I was out. But what a reversal here today.
Yeah, getting back above 3,200 is what stopped me from selling my call spread in GC. So I kept that on, still in a little pain there, but I don't know. I'm really conflicted on gold. Obviously, earlier this year, very bullish. Technically, we have dissolved a lot of the strength, but I think moving under 3,000 would be a lot more concerning. If we could hold 3,200 and this early April swing high, I think we could reestablish a trend here.
Yeah, I actually agree. Just as I'm sort of, I look at the 8-hour chart in oil and I go, did this thing just roll over? Against all odds, what is this thing saying? Here, I look at the 8-hour chart and I go, did this thing just have a false breakdown? Did it just shake me out of my long position and then come right back in? Damn it. And so as I look at this, it makes me actually want to be a buyer tomorrow, because it seems like there's a very, very clear line in the sand here where it comes through and goes, have I broken down? Psych, I have not.
Yeah, it's a chart where it brings up the conspiracies, and it's not even really a conspiracy that the big players have flushed out the weak players. They've reestablished at better prices, and now we move into that next phase, extending the prior rally. I'm going to hold my position here. I think it's, like I said, my confidence is a little lower, but I'm still going to stay long.
And this has been a vehicle very similar to oil, where recently we've had very volatile moves and two-sided action. So we've been trading diagonal spreads and GLD, still very low IV for what it's been doing. But if you're in the futures market, I really liked the broke wing butterflies. So into these big rips, I'll sell a broke wing butterfly above the market, and then if you get the move down, you can remove the risk and have the free shot to the upside on. So that's what I've been kind of trying to do in terms of legging into a position into these rallies that we've seen recently. And luckily, we've seen complete reversal on both of them. Both of these sustained week and a half long rallies have both been reversed, these recent ones at least. So as long as we have two-sided action, I think you can do a lot of stuff and express your opinion and have opportunities there.
And I mean, the IV here is actually decent at 50 and change. So if you sort of took a broad view and said, here's the top of my range, here's roughly the bottom, so somewhere between, let's call it 3,000 and 3,500, and I'm just looking for it to kind of oscillate broadly, not too far away from those bounds. You have plenty of confusion in the bond market, which is the flip side of this. You could have that here. My sense is that it's a really interesting mix within the dollar today, and that sort of starts to tell you some interesting things. So bonds go higher, gold goes higher, yen goes higher, stocks kind of meander. S&P ultimately resolves higher, but we can see NASDAQ here essentially does nothing. So just stuck. But what I thought was especially interesting, the Aussie ends up looking weak. And so you get this kind of risk on, risk off dynamic out of currencies where the risk part, the Aussie, it doesn't sell off. It's consolidating in a range. It still hasn't even given up April's gains, which, by the way, tells you how weak the U.S. dollar is here. Stocks have absolutely barnstormed higher, but the dollar hasn't unclenched at all. Neither have bonds have completely corrected and sort of shaken off their holy moly moment. But dollar hasn't come back. But the Aussie is weaker today. Yen is stronger. It's almost like we're turning into some sort of a lower growth, lower rates kind of a vibe. And that's extending basically everywhere except equities, where you just have this kind of uneasy, wait, do we like lower rates? Is lower rates good? Do we not like lower rates? Is that bad? Are these lower rates for the right reasons? Maybe the Fed can do what it needs to do if it cuts sooner. And maybe that sort of makes for a shallow and short downturn rather than a longer form one. That's sort of how this starts to look. Unless tomorrow the consumer confidence numbers disappoint, which I think would land on a stock market that's kind of uneasy here. If it was shrugging today off, you'd think it would be rallying. But it didn't seem to know what to make of all of this.
Yeah, it feels like equity markets drift higher for obvious reasons, but there's certainly still turbulence under the hood. That's the gist of it, at least what I'm seeing. But yeah, I feel like this kind of feels like a little bit of a calm week before something happens. And you'll naturally see that when you have calming volatility, lower volumes, like this feels pretty natural. It doesn't mean that everything's over. Like, I would be shocked if we just had 20-point moves to the upside for the rest of the year. It wouldn't make sense that would happen. So just be mindful that this is a calmer period, but things can certainly flip in a day's time.
Yeah. I like the yen because if we get back into a fear-based environment, you think bonds go higher, that's going to drive U.S. yields lower. At the same time, Japan reported good inflation data earlier this week. So that gives the BOJ more ammo to increase rates. So I put in an order for a call spread on the yen today. It hasn't filled yet, but the yield premium for the 10-year U.S. versus Japan is under 3% again. And ultimately, that yield premium, U.S. versus Japan bond yields, really drives a lot of the price action in the yen. So I think the yen is a pretty good play here. We had a really big uptick in the yield premium in the U.S. versus Japan in early April. We haven't really come under that too much yet, but today could potentially be the start of that.
There's an interesting and yes, I mean that's absolutely that's absolutely something I agree with, and I'm still holding yen on. So I think there's more, and begrudgingly holding bonds via TLT verticals as well, because it seems like we're finally going to get to go that way. Maybe it's been a while. Let's get to regular recession mode. Stocks and dollar lower, bonds and gold and yen higher. That would be nice. It'd be nice to get back to some level of sense out here. The interesting sort of last thing that jumps out at me is, and Thomas, you wrote about Canadian markets today. If we take a look at the ETF here, we can see very strong upward push today for Canadian shares. What's going on here?
Yeah, I mean, we're up 20% since the April low. That pretty much mirrors the U.S. performance. So, we're we're trading it like the U.S. and Canadian economy is back into a good trade relationship. At the same time, you have a new government, the Liberal Party. They are set to unveil their economic agenda later this month. I think it's May 26th or something like that. But it just appears to be some confidence broadly. The market's going up, so of course there's correlation there, U.S. Canadian equities, but there seems to be some confidence in this new government for Canada. There seems to be like the market believes a trade deal is going to get hashed out rather quickly here. It's interesting that EWC rose today despite crude oil being down 2% today, because the Canadian stock market is pretty heavily weighted towards crude oil producers and downstream companies. So that was a little interesting, but I think it just speaks to confidence in the backdrop. At the same time, you have Canadian unemployment 6.9%. So it's not, the market's confident, but there's still risk, of course. I think it just speaks more broadly to trade measures, having more confidence in negotiations, things like
that. At the risk of being marked off as a perma bear, we might as well, before we end here, mention the one long-term equity holding that I have on the long side, which is Brazil, and Brazil doesn't do terribly great today, but this is one of those big macro ideas where you seemingly have what was a long-term decline here that has now been overtaken, where we started to set a bottom and break higher. So I bought a 240-day call on this, basically, that expires at the end of the year, with the idea that I'm just going to have this and hold it, because if we are in fact reshoring and all of this fire and fury is more about bringing supply chains closer to home, boxing out China and ending up with more regional trade, which is the kind of thing that you would expect coming out of that conversation you just had, Thomas, about Canada, that ultimately the idea isn't to break the link, much like the transition from NAFTA to the USMCA was about more free trade, not less, ultimately. It ended up being exactly the same as NAFTA, just expanded the number of goods covered to digital markets. That all of this is probably good for Latin American markets and countries. And so the place I am long equities of all places is here.
I like it.
With that, overtime is out of time. We could keep going here for a while, but I suppose we'll call it. Thank you, gentlemen, for sitting in. You are, of course, always welcome to join us and offer your insights. Do come back. We're going to take a really quick break, and then I'll be back to drone on about the macro with copious charts on Macro Money. Don't go anywhere.
At tastylive, we live and breathe the markets. But when the live show's over, are we out of breath? If you want to inhale the latest breaking market news, we've got you covered. The tastylive research team and on-air personalities post refreshing content updated daily, covering earnings, economic reports, trade ideas, and much more. If you want a breath of fresh air and not stale takes, visit the News and Insights tab at tastylive.com.
The beauty of Thinkorswim was that we were different.
From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new, who wants to come in on the first floor and work their way up to the top of the building.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
tastylive's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. That's what I do.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options, profit, and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
I think I went down the typical path of investing in stocks, and I was really frustrated in the sense that it was a buy and hope type strategy. And so I was looking at, different ways to learn about options, and I saw Mike and his whiteboard, and it all made sense. There's another world out there with options. It gives flexibility. It's more capital efficient, and tastylive does it again. They teach it in a way that is fun, it's easy to understand, and you're learning from people that have done it for 40 years.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Got friends?
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Stock markets do not know what to make, it seems, of today's onslaught of U.S. economic data, but the bond market is making up its mind. A fire got lit under the bonds today by the economic news flow, it would seem. We're going to unpack what that means and what it might signal for what is happening next. Because, of course, we have economic data coming up to cap off the week in less than 24 hours that might put all of this in very sharp relief and tell us a story about U.S. consumers that gets stock markets leerier than they've been in recent weeks. So let's take a look at what's going on here, break it down. Here is the S&P 500. We can see here it is somewhat higher today, but ultimately doesn't make a whole lot of headway, dips lower, ends up a little bit higher, just a touch relative to the highs hit earlier this week. If we take a look at what all of this kind of breaks down to, we get a rise of just 0.4% today. In weekly terms, of course, a very strong 4.5% rise. But the close today at 59.34 only a touch higher than the high that we hit just on Monday or on Tuesday, rather, of this week at 59.27. So not quite an inside day today, but not exactly screaming of conviction either. But where things did get very interesting indeed was in the bond market, where we had a broad-based decline in yields and a broad-based rise in bonds. In fact, the largest rise in bonds we've seen in a while. We're looking at the 30-year. Here's the ZB continuous contract, and we can see a very strong up candle here today. That's right there. And this extends across maturities. So we get interest rates lower at the 2-year maturity, at the 10-year, at the 5, at the 30, a broad-based move higher in the bonds and a broad-based move lower in rates across the curve. Still more interesting, the move there registers unevenly in the Fed policy outlook, where on the one hand, we've come down to less of a dovish perspective here than even the Fed itself has argued for since December. We have 80 basis points that are priced in for this year and next, cumulatively. And the changes that happened today on net seem to maintain that perspective. This, of course, has been the normalization we've seen playing out from these panic lows at 137 basis points. This basically follows what we've seen from the stock market. So right here is mid-February, where the market is maybe only anticipating 50 basis points this year and next together. Then we have a situation where the view seems to get worse as economic data weakens, and you see this in stocks. So you get a shift that starts to happen in stock markets right here. That's this move that, of course, we see in the S&P. Not surprisingly, that gives you a dovish adjustment in Fed policy expectations because the spook seems to follow alongside growth concerns. You then exhaust at the April low the worst of the panic, and things start to unclench. And of course, this week, as we continue to recover on stocks, the unclenching continues. But the interesting thing in bond markets today lines up with a cementing probability for 2 rate cuts this year. So while the outlook for next year has meaningfully weakened in the sense that it's become less dovish, the tally for rate cuts next year has significantly wound back. For this year, we've really cemented around the level that the Fed itself has argued for, and the probabilities shifted today. We were only looking at perhaps 47 basis points or even as low as 44, priced in over the course of the week here so far. We're now at 51 basis points, so we've really cemented that the 2 cuts seem to be coming, whereas for next year, we're at 29 basis points, having been as high as 38. So it seems like about 10 basis points here shifted up in the trajectory. So the markets seem to expect sooner cuts and are surer of their arrival. So what gave us this curious response, and what does it mean? We begin with the retail sales data. This was a very important check-in on the health of U.S. consumers. And what we end up with is an outcome that's slightly better than expected, a 0.1% versus a flat result, which was the consensus forecast. But nevertheless, a very steep slowdown from the preceding month's revised higher 1.7% rise, which you can see was the strongest 1 month increase in retail sales since going all the way back here to early 2023, late 2022. So, needless to say, a very significant cool down. And when we look at the internals of the report, they don't necessarily scream positivity. Notice in the red here is the component breakdown for the March numbers. That's last month. In the blue is April. That's the data we saw today. Notice there are no big upside spikes in the blue bars here. And the red bars, that big 1.7% spike, seemingly powered by a 5.5% surge in the motor vehicle category. That's cars and auto parts. And of course, we've talked about this before, and we covered it in detail yesterday. This largely seems to front-run the auto and auto part tariffs introduced by the White House. Now, of course, what did we see in April? The president unveiled so-called Liberation Day reciprocal tariffs, which spooked the bejesus out of markets and obviously showed consumers that the prices for imports across a whole vector of countries is going to be much, much higher. But then on April 9th, after some consternation in the bond market, the president walked it back, at least partially. Said that there's going to be a 90-day pause on rates above a new floor of 10%, which, of course, is already a 5-fold increase relative to an average tariff of 2% before this announcement. And that's this rally right here. So consumers start April with, oh no, much higher tariffs, and the markets reflect this. And then, oh, there's a pause in the worst of this for 90 days. And that cliffhanger now is in early July. China is initially exempt, but after the deal this weekend that gave us this surge right here, we now have a 90-day pause in tariffs above 30% for China. That's a major climb down from the 145% rate before this weekend's apparently friendly talks in Geneva, Switzerland. So we're in a situation then where consumers might have been expected to do another bout of front running because they were just shown scary tariffs and then said, okay, now you get a window to buy whatever you want before these hit. Go ahead. And one might think they would do the same thing they did in March, which is see the higher costs immediately on the horizon and try to buy whatever they can before those hit. They did not do that here, although one would think the narrative encouraged them. Then we get producer price index data. This is wholesale inflation. Whereas earlier in the week, we saw consumer price index data. That's retail inflation, essentially. And here, what you saw was very surprising indeed. A decline month on month of 0.5%. Now, first of all, that's the first decline since going all the way back here, essentially a year and a half. But the magnitude of this decline is what's really striking. This 0.5% drop is the biggest since back here at the onset of COVID, where supply chains obviously were in full lockdown mode early in the year. So this is telling us a story that's quite interesting. And when we actually get into the breakdown of these numbers, produced helpfully here by Bloomberg, we can very clearly see where the change came from. So here's that 0.5% decline. If we strip away volatile food and energy prices, it is still a negative reading, albeit a more modest one. We can see that goods prices rose, as you might expect in a trade war. But the big turn here happened in services. Services had a dramatic pull down on overall wholesale inflation. And when you look at where that came from, the culprit seems to be a 0.7% decline under the surface, powered by a 1.6% decrease in margin for trade services. Now, what trade services is in this context is the cost of moving goods through the supply chain. So you get the goods into port, or you get them into the factory. You then, once they are in whatever state of doneness that they are, ship them to their next spot, either to be finished or to be sold. So the cost of moving wholesale inventory through the U.S. supply chain, from ports to warehouses to store shelves, that's what the trade services component here is. And of course, the cost of tariffs would appear there. The drop in margins then in that space would suggest that companies are eating higher goods costs and not passing them on to consumers. So here's the goods costs, they're rising. And companies are saying, instead of us passing this on to consumers and maybe driving those consumers away and losing market share, we're going to eat this for a while. We're going to bite the bullet and see what happens next. But what it also means is that consumers were insulated from a good bit of the tariff increase, which, on the one hand, explains how the CPI report this week was so refreshingly normal. For consumers, goods prices, core goods prices, barely budged. All of the inflation was still in services, and there it cooled a little bit, in line with a trend that's been developing for quite a while. Now, what's particularly interesting then is, why didn't consumers front-run incoming tariffs in retail sales? They were being insulated by businesses from the price increases that are already occurring. So why are they so anemic, and why are they so defensive, if in fact they are being shielded, at least for now? Then a third piece of data appears, jobless claims, which tells you that while the changes week on week in initial and continuing claims were not especially different from expectations and didn't really break any ground in trend terms, the 4-week initial jobless claims average, that is new applications for unemployment benefits averaged over a 4-week period, to give you a sort of sense of where the monthly trend is, that jumped to the highest since October of last year. And we can see it's been building steadily since the beginning of the year, suggesting that there are cracks appearing in the labor market. Now, this makes for something of a vicious circle when you put this in context of the other data that you saw today. Weak uptake for labor tells you consumers are going to be defensive. They're probably not going to be as enthusiastic to spend, even when, as we just saw, they got the green light to front-run incoming tariffs, and businesses have shielded them from price increases to goad them to keep consuming. But nevertheless, they pulled back, perhaps because they see what's happening in the labor market and have become belt tighteners in that context. Now, of course, that kind of retrenchment tells businesses they need to keep eating the price increases and pushing them into their own margins. And that, of course, makes them more reluctant to hire, because that's not exactly the time or the position that a business would feel confident about increasing payrolls. And so, to the extent that this dynamic feeds on itself, it creates a negative feedback loop for the entire economy and for consumption writ large, which, of course, is very interesting indeed for a start to the second quarter. We'll see a first look of what it appears to be in the month of May, as we get this update of U.S. consumer confidence data that's incoming here over the next 24 hours. And we can see the expectation is that it holds near these 3-year lows that we hit in April. And largely, we can see that this is being driven by this massive surge in 1-year inflation expectations, no doubt reflecting worries about these tariffs. As a matter of fact, we can see consumer confidence was declining from the beginning of 2021 as inflation was heating up. We can see those inflation expectations rising. Then, of course, at the beginning of 2022, the Fed starts cutting rates, so inflation or hiking rates rather. So inflation expectations start to cool. You actually start to see inflation come down. Consumer confidence improves. It peaks as inflation expectations round the bottom. And as we get into now the meat of the trade war, they surge. In fact, they surge so dramatically that they are now above these COVID melt-up highs. And the expectation is that you're not going to get very far away from those things in this most recent survey. And so you start to get the sense that you're getting a weak consumption backdrop in the second quarter. Consumers aren't confident. There's no uptake from them, as even these tariff cliffhangers create an incentive for front loading, and even as businesses act as shock absorbers on tariff cost increases. That, of course, is an ominous sign that consumers are this defensive. Because what we saw in the first quarter GDP numbers was, in fact, the weakest contribution from consumption to the overall GDP pie in close to 2 years. The last time it was that small was the second quarter of 2023. So once you strip away all of this noise, the surge in imports from front-running the tariffs by businesses that are stockpiling inventory, which you see here in the investment component, because they're not shying away from front-running these tariffs. If they can build up big inventories, that's less of a difference that they have to eat for as long as those inventories last, and they have to restock them at the higher tariff rates. So, washing all of this out of the equation, episodic though it is, the bedrock here, consumption, is weak. And if we look at how much each of these components accounts for the total, we can see exports and imports are somewhere down here, sub 20% of the total. And when we net them out, we end up with an overall contribution to GDP somewhere in the vicinity of 4.5%. By contrast, consumption accounts for 68.5% of GDP. So as this goes, everything goes. And the story for the first quarter was weakest consumption in almost 2 years. And the story today, out of the retail sales and PPI and jobless claims numbers, are perhaps weaker consumption again in the second quarter. Tariff impetus or not. And of course, that is a very worrying sign indeed, because already the PMI surveys are telling us that the U.S. economy, which last year was quite buoyant indeed, we can see here in the PMI numbers, these are, of course, centered around 50, which is neutral. Above 50 is growth. Below 50 is contraction. The further above 50 you go, the faster the growth. The further below 50 you go, the faster the contraction. And so you have here the U.S., which was dramatically outperforming last year relative to the other big economies, the Eurozone and China, the other major engines of global growth. So we've talked about extensively before. The three big influences here make up a whopping 58% of global GDP, and the remaining 42% are mainly vendors to the three. And so it's really these three that matter in terms of overall global growth dynamics. We can see they've slowed down to basically hug this 50 line. And while Europe and China were going there and have been this anemic basically since early into the middle of last year, the U.S. was strongly outperforming until at the start of this year. It's now converged back to this standstill zone. And if in fact we're going to see weak consumption out of the U.S. in the second quarter, well, then this in fact is telling us a story of a real downturn, not only in the U.S., but globally. Because if all three of these things are in standstill mode, well, then there isn't very much growth to go around. That would, of course, help to explain why today's data created a pullback in yields. It would explain why a sense of urgency emerged in Fed rate cut expectations, even though it hasn't moved out further into the outlook. And as we look at what stocks do next here, especially relative to this consumer confidence data, it starts to raise the question that maybe this growth-based sell-off has room to return here as markets decide whether their resolution of the headline risk has also resolved the economic risk, or if in fact the economic risk is the thing to be worried about now. And that is Macro Money for today. We're here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. That makes this the last show of this week, so Macro Money will be back on Monday. I'm also on Futures Power Hour Mondays and Fridays with Chris Vecchio. I am on with Victor Jones for The Price of Truth on Tuesdays, on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back next week. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than, boom, trade like a trader. Tasty Trade. Make your move.
Your crypto needs a wallet. And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
What is going on, everybody? Welcome back to Risk and Reward with Gus and E. Volatile days in the market, still heading to higher highs. When will it be over? I don't know, Gus. We got some things to talk about. United Healthcare scandal. Biggest talk, biggest headlines right now. With that underlying, options are still trading right now, but we'll get into all of that here in a moment. Before we do, Gus, what's going on, brother? How we doing? How we holding in there?
Yeah, UNH,
almost the end of the week.
UNH definitely talk of the town. I'm having a great week myself as far as my personal portfolio is concerned. Just been taking exits, slowly redeploying some capital in some creative ways where I'm where there's perceived value. So yeah, feeling good as a whole. Big day today for me. Kind of just got big right at the end.
Yeah.
TNA took a nice little ripper to the upside there at the end and put some IV into my options to make my P&L on the day look a little bit inflated. But it's that's fine. That's fine.
Yeah, I'll
Never
take it. Yeah.
It was like one of those funny situations when you'll see your P&L shoot up $200 because there's one little weird spike in IV, but it just happened to happen on the last second of the day. So now I get to look at it overnight and feel like I'm
that's
great.
That's nice.
Which is fun.
Yeah. Hey, no. Well, you put the position on. I know it was all the long deltas we were talking about on Tuesday, right?
Yeah, I don't think. My Alibaba risk of the week, I got short Alibaba on Tuesday. That was my only short position in my account, which I have now exited half of. I'm still holding the other half, hoping for a max profit. It just continued to work down throughout the day today, so not particularly concerned there. But good day. I'm long everything, and the one thing that went down, I was short.
Know.
So I'll take it.
Yeah. I know. I mean, I know we'll get into the market. We'll get into the platform, do a little bit more of a recap on what's going on. But yeah, I know Nvidia. That was the one that I got short on so far for Tuesday. Nvidia's still been kind of rallying a little bit with the overall market. So I just couldn't believe. Like, I put on a long position on QQQ yesterday, and I didn't even really want to put on a long position. It was just more of the buys, but it's like, I can't believe we're still heading to higher highs. Like, this is the overall market where, just a month ago, I think we were the beginning of April, I think we were trading down underneath 20,000, I think somewhere around there. But just in the blink of an eye, it always feels like you said on Tuesday, they always say the market moves down like an elevator, but it's been feeling like it's been the opposite as of late, at least. But we're going to get into some of the market news today. We got UNH, United Healthcare. Did you see this coming, Gus? I mean, it's like whenever we see it or hear certain news topics come out, it's like, you know what? That makes a little sense. I know the CEO stepped down, and then I know there was more sus things that was going on with United Healthcare just over the last 12 months. Does this catch you off guard at all?
It's not surprising. I certainly wouldn't say that I'm surprised. I wasn't shouting from the rooftops that I think the UNH CEO is going to step down or anything like that. But given the way the last CEO departed the company, I am not surprised by this one, taking his money and hitting the road, I suppose. But yeah, it has been just this crazy shakeup. I mean, it's down almost 60% on the week now. And yeah, it's really been a spectacle.
Yeah.
Lots of money. Lots of money lost, lots of money gained. If you were short UNH through all of this, congratulations. I've seen some insane screenshots on social media.
I wouldn't doubt.
Yeah, I saw a guy on Reddit this morning who went $720 into $250K on. Wow. He had like 2 contracts. That's of like 590 puts or something like that naked, and it's gone absolutely ballistic. So it's quite something.
Yeah, especially I'm curious about the short interest on UNH too. I know with all the controversy with UNH over the last year, especially, I think that drives a lot more opinions, and people will start putting money behind those opinions. So because people feel very strongly of one way with United Healthcare, I'm curious about the other positions that worked out really well with people to the downside, because I know a lot of people feel, United Healthcare rubs them the wrong way. So, maybe that influenced some traders' opinions on their overall bias. And if it was to the downside, they definitely caught a massive move. But I didn't see it coming at this point. I did get on a UNH position today. So defined risk, of course, just because. Did you? Yeah, it almost felt like you had to. You just had to take a stab at it. So we'll get into that here in a moment. But if you were not aware, United Healthcare Group has been getting crushed. And like Gus mentioned a minute ago, about a 60% decline, over 50%. I mean, since mid-April, reaching about a 5-year low. And I know we went to a low at about 248 roughly. But this can be attributed to multiple factors. I know the scandal or the potential fraud that could be going on right now was kind of the straw that broke the camel's back. But we already had a lot of controversy over the last 12 months. So it can be really attributed to a few things. Number one, the criminal investigation. The U.S. Department of Justice has reported that they were doing a criminal investigation from last summer on UNH with a lot of fraudulent potential practices going on over there. So it's a lot of unconfirmed news right now. But have you ever seen unconfirmed news affect and underlying the way that it's affected United Healthcare without having like official rulings on exactly what's going on right now?
Yeah, no. I mean, the answer is simply no. It's become such a spectacle. And like you said, I think that it's largely driven by sentiment, by the fact that a lot of people do not like United Healthcare and would like to talk bad about them and would like to see them fail, which, has become an even more prevalent topic with the murder of the previous CEO and everything surrounding that. And there's some people who are on Luigi Mangioni's team and all this good stuff. So, yeah, I think that because... And I mean, and it's funny, but this is just how the market works. Because people want to see it go down, it's going down, and that's the it's basically what we're seeing.
The market moves off of vibes. Yeah.
The closest thing I can think, like the closest comparison that I could make, is the way that for a minute there last year, Boeing was moving down every single time the most routine issues would come up. Yes, a door blew off of a plane. That was a serious situation. I don't mean to make light of it, but then
he's like, yes, of course. A door blew off a plane. What's the big deal, guys?
But
what's the big deal? No, go ahead.
After the door blew off the plane, suddenly it launched the media into this reporting frenzy on every single aviation incident that happens ever. And I remember one time reading a story about a plane had to land because a wheel fell off of it at LAX. And that is something that would never make national news if a door hadn't blown off 2 weeks prior. It was all just in that reporting cycle that everybody was freaking out about aviation. So I think that's like the closest recent comparison that I could draw, is Boeing was taking big sentiment dips like that, but it was nothing like this. It was not this fast. This is crazy.
No, I mean, that's a really good comparison. And I mean, back to the wheel, maybe it happens more often than we've seen it on the news, but maybe because it popped up on that headline, it's like, we never see headlines like this. Like, this can't be normal. This doesn't usually happen. So yeah, definitely get a lot of a reaction. And it's almost like we talked about the other day, the market and a lot of these underlyings are moving off of vibes, are moving off of just kind of, I feel like vibes is a pretty good word to use for, market sentiment.
Yes.
Right. So CEO resignation, right? Like we just talked about, CEO resigned. And I mean, just before a lot of this criminal investigation news was coming out. So maybe he knew about something beforehand. We could do we can take context clues and take that for what it is. But just a lot of controversy overall. And then the financial outlook withdrawal. I mean, I know with the insurance industry, especially with United Healthcare, I believe there's about I think I was reading around $125 billion in fraud surrounding United Healthcare. It doesn't mean it's inside of United Healthcare, but whether that's outside sources hacking into the databases, taking information, whatever it is, but just within that industry, especially with United Healthcare. So I'm just curious to see how things are going to pan out. But based off of how the underlying is looking and based how we're positioned right now, depending on the news that comes out, hopefully it's going to be like a sell the news kind of, maybe like a sell the news kind of reverse play we're getting into right now, because maybe we get a little bit of a pop once we do get a little bit more clarity on the situation. But either way, extremely sold off. Premiums are pretty juiced up right now. So it was a good opportunity to take. Anything to add before we hop over to the platform right here?
Yeah, I think you make a great point right there. This is a very interesting opportunity to be contrarian and try to get long on this. They are still one of the largest companies in the world. They're still the largest insurer in the world.
The largest.
They have all of these things going for them. And is a 60% dip in share price for your CEO stepping down, pulling your forward guidance, and potential fraud too much? I think it might be. I still think it might be. Just
a little bit.
Like, say we're in a world where this fell 30 or 40% on this news. No one would be saying this thing has more to go, because I think that would maybe be a justified amount. So yeah, I do think that this is a stock that we'll see return to those 400, maybe even 500 levels in the coming 24 months or something like that. So yeah, there is interesting opportunities that present themselves, and I picked up 5 shares myself.
Yeah, 100%. Those shares, they've been working out really well for you. I know that long delta, especially into this week, boy, I know those have been paying for you.
They have.
Yeah. Oh yeah. But I do have a few positions on right now. We got some expiring really soon, actually. So we do have the UNH position. That was from earlier today. I was going back and forth on this one, just figuring out how we wanted to position ourselves. I ended up going with the at the money put spread that I sold. So I sold the 250, bought the 240. It was a $10 wide, collected about 438, so almost 50% of the credit received. So went a little aggressive on that, but also reduced the risk a little bit by being able to receive an additional, roughly in $1 worth of credit from what we typically get for a $10 wide, which would be about 330 something. So we did that in UNH, 36 days out. This one was a difficult one for me. I wasn't sure which expiration date to choose, but I really liked 36 days out, June 20th. Not too far out, but also gives me a little bit of wiggle room for the first few weeks with all the uncertainty. And then we got SPY, sold an out of the money call spread on SPY. The market has been going on an absolute tear. So this P&L has actually been transferred straight into Gus's over here, because the market's just been working against me with SPY and QQQ. So we got a couple of positions on in there. And then we have the QQQ position. The one down here, the put spread that I covered today was into the rally today, so I closed that one, but I do still have a short call spread on in QQQ that expires by tomorrow. So unless we go into World War III by tomorrow, most likely this is going to expire in the money, like legitimate, like unless we get some insane random news that can tank the market that much, then these ones are going to be expired in the money. So we'll keep an eye on it. And then NVIDIA, this was the risk of the week. It really hasn't gone anywhere. We're down a little bit on it, but we haven't gotten too much movement. Overall market's been floating to the upside, so NVIDIA has been following suit just a little bit. And we're going to stay patient there, but this is what's new for the portfolio so far today, Gus. Not as much green action like yours. We don't have too much, or we don't have as much long delta in here right now, at least.
Yeah, I certainly, I have certainly been taking your money on that one. This QQQ, especially, I have a long QQQ position open right now specifically. So there really is some transfer of funds happening there. But yeah, outside of that, only update I have outside of the UNH shares, which I already mentioned, I picked up some Rivian Leaps yesterday. I picked up 2 naked calls, both on the September 18th, 26 cycle, 491 DTE. I bought a 12 and a 20 call. I gave my pitch about Rivian when it was the risk of the week 2 weeks ago. I have an article on Luckbox about it. But the more and more that I read and research into this company, the more upside that I think it has in the next 365 days, maybe 18 months. They just got everything going for them. They're tariff proof. Almost everything that they do is domestic. They're rolling out their R2 line, which is going to make them much more competitive with Tesla into 2026. And I think that the continued forward guidance that comes from that is going to do a lot to pump their share price up early into 2026. And I just like it. I wanted more exposure than what shares could offer me here, and more potential upside than what shares could offer me. So that's why I went for the leaps. And then I got one in the money, and then one at 20, which is out of the money, but by no means outside of reason with how this company has moved in the past. And I think that we are entering Rivian's 2 years right now is what I think. I don't think they're going to dominate these 2 years, but I think that in 20 years, when we look back at how all of these companies came to be, it's going to be 2025 and 2026 when Rivian really took off and asserted themselves as a big player in the EV space. So, plenty of upside room. And I mean, what if it's like, I would be great if these things are just in the money by the time that expiration is creeping up 491 days from now. But I mean, what if it goes to 60? You know, like there is. I feel like there's crazy potential.
I mean, I don't even 100%. I don't even think that's, I know we like to be realistic, quote unquote realistic, but I don't think that's too far fetched either. I think even beyond 60 is definitely possible if it catches a little bit of headwind, especially with just the EV sector as a whole. I mean, Tesla starts taking off, maybe we get another hyped up EV sector. You never know. So within the next 490 something days, you got some time.
491. Yeah. So we'll see. But
491.
Those are actually already up handsomely as well. Things are moving. So today was a good day, but gonna be a lot of exposure to Rivian for the next year-ish for me.
100%. Let's check out Tesla quickly just to see what the leader of the EV space has been doing as of now. I know there was a lot of headlines with the Tesla and was it Qatar? Were they in Qatar where Elon had his Tesla truck out there? And I think I've seen a couple headlines of that where it was a little controversial too, where they had Elon's Teslas out there in the Middle East. I can't remember exactly where he was meeting.
Everything has been Qatar this week that I've seen, like everything political. I haven't seen anything about Tesla specifically, but that's probably right.
Okay, yeah, I know when Donald Trump was being escorted, I think in the very front, it was like a red Tesla whenever they were out in Qatar. So that was probably another photo op, but there was a little bit of controversy that made some headlines. But I was just seeing how Tesla stock responded off of that. But I mean, I even think whenever we see something like that with Tesla, for example, right, a photo op with, leading the presidential, driving down the road, and it more progress that Tesla makes is going to be only better for all EVs for the most part in the space too, because clearly Elon Musk and Donald Trump are buddies. Clearly, they're getting great photo op opportunities, great business opportunities, this, that, and the other. I think when you're friends with somebody that is in such a powerful position, like you're friends with the president, that whatever industry or sector that you're in, regardless of your opinion, I feel like you might, if you're going to put your money behind it, I would lean a little bit more to the EV space, especially when, somebody kind of has ties with somebody that's in such a powerful position, especially with California not going to be producing gasoline powered vehicles past 2030, I think it might be. So there's a clear change in terms of how we're going to be using transportation with a lot of these vehicles. So regardless, I like Rivian. It seems like we're early. And I mean, we're sitting at 15 right now. It seems like we're pretty early in the EV space as a whole.
Yeah, I think that there's interesting plays to be made on, and I don't know, there's a lot of angles to consider with Elon politicizing himself a little bit, because on one side, anytime any company politicizes themselves at all, you immediately eliminate half of your potential customers. That's the way of the world. But on the other side, we're in possibly the most divisive political time we've ever seen in America, straight up. I mean, as people are at each other's throats. And so because of that, that also means that now I think that conservatives are going to be racing to buy Teslas at clips that they never would have before. And simultaneously, you have people on the other side of the aisle who are going to be switching away from Teslas pretty aggressively, which flushes money to Rivian and these other companies. Mm-hmm. So I think it's really interesting to see the balance of this and how it's all going to shake out if a very passionate one side can be a better business model than trying to appease everybody, and how that whole calculus is going to work. But that is also part of my Rivian equation, is that I just think over the next 4 years, I don't think that the division is going anywhere. And I think that there is going to be a pronounced switch to Rivian from Tesla among many people who are upset by Elon's affiliation. So there's maybe an angle there as well.
That's a really good point that you bring up, because of the dislike for Tesla, it's creating an opportunity for other runner-up EV companies, if they're ever deciding between two choices, a Tesla or a Rivian or whatever else vehicle it might be. But at the same time, I think it is interesting, just with the marketing tactics of Tesla right now and just the EV companies as a whole, you're going to have it kind of divided, but at the same time, when you divide such a large percentage of people, even that half might be a massive amount that you already have because it's on such a large scale. So I don't know, interesting times just to see how things are playing out right in front of us. We'll see where the EV sector goes, but Tesla's still been really volatile. Rivian, it's got to be early. I've seen another Rivian the other day. I think they have those little pouches like behind the second. They have like the little slot on the side of their car. I think they're marketing something like that. Really good for like camping and going on adventures type vehicles, but they've become a lot more popular.
Yeah, definitely on the up and up, and EVs as a whole are only going to be on the up and up, I think. So, it's just a lot of upside. I mean, it's a similar line of logic to what I say about gambling and weed stocks sometimes. As with that line of logic, is I will say, if something is not legalized everywhere yet and is going to be legalized everywhere, then there is clear upside from that reality. And EVs, while they're obviously legal everywhere, it's sort of the same situation where wide-scale adoption of EVs has been slow and it's just starting to take off. We're still kind of just at the tip of that iceberg. So it feels to me like as long as Rivian is smart with their finances and their marketing, they have no choice but to grow, just because the number of people driving EVs and interested in that market is going to grow. So
really good point.
Yeah, Trevor in chat, Gus reads Wall Street Bets. I do read Wall Street Bets. I will take this quick time to shamelessly plug our subreddit, r/tastylive. I have been put in charge of spearheading some activity on r/tastylive, and we would really love to get the community more involved. So please, everybody, go join r/tastylive, contribute, post something. I'm responding in there to everybody pretty much every single day. So if you guys want to hear me yap or do some yapping yourselves, you are more than welcome. Please come hang out with us.
100%. I know we were talking about Hum a little bit here too. Decent premiums. This isn't a terrible trade idea. It's been absolutely beaten down.
Yeah, this Humana is one that I used to trade pretty often. I don't know why it's fallen out of favor with me, but when I was first getting into trading, and then into 21 and 22, I was trading the shit out of the stock. I would do it a lot.
Yeah. I mean, you can get $1.60 for selling the 30 Delta right now. We're not all the way at the expected move, but we're pretty close. We can do that for a 66% pop. I don't hate it. I mean, new lows today. It's been getting absolutely killed. But I don't hate it. The premiums are pretty solid. Decent liquidity too.
Yeah, it's not bad. They're loosely insurance, right? Is it? I don't really know what Humana does. The closest affiliation I have with Humana is that my house, the entire time I was in college, the previous tenants did not do a change of address with the post office, and I would get these gigantic, thick Humana packets for them once a week, and I was always throwing them away and thinking about how wasteful it was, but I wasn't going to open them or do anything with them. Obviously, they're not for me, so what are you going to do? But yeah, Humana, they be mailing packets. That's my experience with Humana, is that they send packets in the mail.
Okay, well, I wonder if they have adjusted or adapted their marketing strategy, because if they're still mailing things out, maybe that's why we haven't heard about them in a while. And maybe that's why they're making new lows. Regardless, I don't care. Premiums are pretty juicy right now. Appreciate the
do
trade
they know
idea,
that
chat.
Gmail is free? Somebody tell them that Gmail is free to use. They're allowed to. We don't really send paper mail much anymore.
Yeah.
But
we'll see what we get there. This is what I'm going to be looking at, so maybe we even add this to our watch list as we have a couple minutes left here.
Yeah, what else we got going on? I'm looking for
sectors.
Anything else I was eyeing today? My Match.com position has been slowly appreciating, but the recovery there has not been as rapid as I had hoped. But I will tell you what I was exactly right about is DoorDash. DoorDash rocketed out of that poor earnings call. I don't know why it even went down in the first place. It was why I bought it. But yeah, DoorDash, big, right back up, V-shaped recovery. I'm right at the bottom of that most recent big red candle. So yeah, I actually exited the last of my shares today. I was targeting 200 and it was at 198. I was like, that's good enough. So got out on those DoorDash shares. Still have a vertical open. I just needed over 170 come August 15th. I was giving it like plenty of room in case it needed room, and it did not need room. It's back in a week.
No, that thing is ripping to the upside. I mean, we're near its highs over here on DoorDash. So 214. DoorDash is one of those companies I'm like, man, how did nobody come up with this 10 years ago? Or how did I not think of DoorDash? You know what I'm saying?
I was just reading about the founders of DoorDash. They started it at Stanford because they wanted to get noodles delivered from this place, and they couldn't get their noodles. What I heard. Or no, cookies, rather. Cookies. It was a bakery. They wanted to get cookies delivered, and they couldn't, so they started a company to deliver for the cookie place, and here we are.
I actually think they're revolutionary in terms of opening up people's minds a little bit. Like, I feel like it's one of those business models. It's like, deliver my food to me. I don't want a stranger handling my food. I feel like it's one of those things. It's like, okay, that business model was extremely successful. How else can I be a little bit more convenient for people? And then I feel like people dip their toes in the water with trying a little bit more things. But I feel like the food was the pivot point on that, because I mean, a stranger handling your food, I feel like I'd rather put my credit card in the internet in 1999 than have a stranger bring me my food when it's the first time I'm hearing about that idea.
Well, yeah,
so
and especially when DoorDash was in kind of its infancy. Like, now restaurants have the infrastructure set up to deal with DoorDash. Like, you never get a DoorDash that's not like sealed some way. They have stickers or whatever. Different restaurants do different things. Sometimes if you order from a mom and pop place, they just staple the bag, but like things like that. But at the beginning, I mean, it literally was just like some guy pulling up to McDonald's and putting in your order for you and then bringing your stuff to you. It's like, you don't know what's going on. You don't know what they're putting in your drink or taking fries out of your bag.
And it might even be secured. It's just like the thought of it originally, like when it's first brought up, it's like the thought at face value. It's like, why would I sleep in why would I let a stranger pick me up? Like, I grew up learning the complete opposite. So one of those things.
Yeah, it's just funny. I mean, it's the way of the world. Basically everything that we use now, I can look around this room and point at things, and everything seemed crazy and stupid sometimes. So it's pretty impressive.
Oh yeah.
LOL.
100%. Well, that's gonna.
Yeah, I guess maybe
1999. That's what I'm.
Well, when did I'm not gonna speak on this. I don't know this credit card acceptance timeline here. I was about to talk out my ass. I'm not gonna do it.
No, I mean, either way, whenever that was, I mean, it was just, look, I wasn't at the age to where I had a credit card in 1999 anyways, or early 2000s for that matter, but even I knew, like, that's sus. Even I knew at that age. So, anyways, anything else to add before we hop on?
Were you born in 1999?
98.
Oh, old head, Unk.
Hey, bro,
Unk over here, bro. This guy's birthday starts with 19, y'all.
Hey, I was gonna make a joke when you were saying 1999. I was like, I don't know, Gus. Were you born yet?
I wasn't. I'm 2001. So yeah.
Oh. Yeah. That's crazy. That's crazy.
Well, you got the chance to do the 3 centuries thing, though. If you make it to 2100, you can do 3 centuries.
Oh, I'm right on the edge.
Yeah,
I'm right on the edge.
Well, that's the thing. You can live if you live until 2100, you live in 3 different centuries then, because you catch the very back end. So you got that going for you. I don't.
Yeah, I mean, we got an 89. Wow. I mean, we're really going back now. No, I'm just kidding. Well, that's going to wrap it up for today. That's going to wrap it up for today's segment. It's going to wrap it up for today's segment. Thanks for taking the time to hang out with us today. We'll see how these UNH positions play out over the course of this next week or two. So we'll be managing that, but we will be back next Tuesday for another Risk of the Week. Be sure to check out the subreddit and get some conversations going on there. Talk about managing this position. Maybe UNH will be a bigger topic. So that's going to do it for today. Be sure to stay tuned for more segments coming on next, and we'll catch you guys next time. Peace.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Craig in New York City, what's up?
I just want to say, I've been with you since the very early days of Thinkorswim, and traded all kinds of markets here and there. And I got to say, I could be off so much worse if it wasn't for what you guys have sort of drilled into me over years and years and years. And so I just want to thank you, because you could have easily just taken the money and run when you sold Thinkorswim, and you didn't, and you started this. And you basically have just given me this full education in this thing that was completely foreign to me many, many years ago. And so even though I've lost money in the last few days, you've saved me a lot at the end of things. It's like losses could have been catastrophic, and they're not. Cool. So I appreciate you.
I hear you.
I appreciate you guys. Thanks so much.
Thank you, man. And I appreciate you holding on the line to say that to us. So thank you.
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Dear Kaylee, hats off to you for being such a culinary genius. I don't think it has ever dawned on our kitchen staff to serve gazpacho hot. Sincerely, Bob.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
I don't want to fact check you with my vagina, but I will.
From the smart mouths at Tasty Live.
If you missed the live show, here's our cherry on top yearly recap.
Breaking news on Instagram. The first segment of your line dancing has been posted. Left together, switch, turn. Right together, twirl, turn. Hip, hip, hip.
Right together, spin, clap. Left together, spin, clap. Hitch, 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 turn, shuffle, rock, shuffle, rock, shimmies. Shimmy.
I took 5 lessons for Casey's wedding, and all I knew how to do was
right together, spin it around. Yup. And you want to clap. And then like strut, down, strut.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Dear Kaylee, hats off to you for being such a culinary genius. I don't think it has ever dawned on our kitchen staff to serve gazpacho hot. Sincerely, Bob.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
I don't want to fact check you with my vagina, but I will.
From the smart mouths at Tasty Live.
Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade. Make your move.
Oh, yeah. It is Thursday, May 15th, or so they say, a little bit after 5 p.m. Central Time. The best time. You know what that means. It's time for Tasty Live's evening show, a little podcast. A little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. And while there are less incentives over the last few days, I would argue, than perhaps 4 or 5 weeks ago, they are still giving us some things to chew on. More on that just a bit. Before we get there, we'll say what's up to the people. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't already have both, do yourself a favor and go get them. But if you want to be part of, boom, this little guy on your screen, this little chat box, there's only one place you can do it. Head on over to Tasty Live's YouTube channel on the evil Google YouTube. Head on over there, subscribe to the channel, and you too can place your thoughts, both appropriate or otherwise, eternally on this stream forever. So get on over there, start bashing your phalanges, your metacarpals, maybe even your skull against the keyboard, create random ass characters, and spoof the Google algorithm into putting us in front of as many people as possible. Deprogramming the world, one little view at a time. Shout out to everybody in the chat. I see all of you. Look at you guys. You're ready. You guys are ready for today. I think you guys have had a decent week, if I had to guess. Victoria, how are you? Catan, great to see you. Theta, absolute beginner. Emmett. Brian, the YouTube goat. Edward, how are you? Did I already say Lone? Lone, if I didn't, I said your name twice. Go buy a lottery ticket. Donna, how are you? Bobby Lewis, what's happening? Adam Green, great to see you. Logan. John, what's up? Great to see all of you. I would sit here and just shout you out for 60 to 90 minutes, but I am contractually obligated to do something else. Nobody's talking about inventory bloat from front-running tariffs, which could cause deflation. Come on, Vic. Yeah, nobody's talking about the bullwhip effect either. Kind of similar idea. I'm telling you, you know what would get you in trouble every single time? You got me going off right away. Right away, you threw a bomb in my show. You know what kills people? There's two things. I was thinking about this the other day. I was thinking, if you could give somebody sort of an edge, it's not alpha in a way, but just like if you could distill some nuggets of wisdom, whatever, if I've been able to acquire any nuggets of wisdom at all. But if you could distill some very important ones and just kind of give it to somebody, it's not like buy this here. It's none of that. It's just very simple nuggets. What would they be? And the first one is avoid linear thinking. So try desperately not to fall into the trap of recency bias and then linearly extrapolate what has happened yesterday straight out into the future. And as simple as that sounds, so many people do it. So many purchasing managers do it. So many CEOs do it. So many traders do it. Politicians do it. It's so common for people to take what happened yesterday and straight line those events out into the future. That would be number one. If you can avoid doing that, think of each new day with a new possibility, with its own probability distribution. You're probably in a better space than a lot of people. And then the second one, it's much more simple. I actually think it helps in so many other parts of life. It's when you read something or when you see something, it has to do with the availability bias. I go, if you read something or see something in the news, something like this, the first thing you do is you ask yourself, why am I seeing this? So of all the things that happened in the world on a 1-day basis or on a 1-hour basis or over the last 3 months or year that could have been reported on, that could have been deemed important, that could have been deemed newsworthy, that could have been assigned the report, assigned to a reporter, that could have been placed in the news article or the magazine or on the website or in your feed. Why am I seeing this? I think if more people ask themselves that question before they sort of process the information that was coming in, I think, I think things would be different when you looked outside the window. It's a weird thing, Somebody asked me that question.
Park City dwelling in Utah does not have room service, but it's
Paul, what are you doing over there, bro? Hit mute. What are you doing? I love you. That's my sign to move on. I think Paul just played me off on my opening monologue. No, but I think just asking yourself why you see something is so important. So those two things, the availability bias and recency bias. Let's get going, my babies. S&P 500 up 0.2%. This very interesting slow grind higher over the last couple of days, and it's a similar pattern. Be careful with patterns because they mean absolutely nothing. Just because I say this pattern doesn't mean it's tradable in any way. It almost do you a disservice for me saying I'm going to say it anyway. Markets start off a little weak in futures, maybe an hour before the open, something like this, maybe 0.5%. This is the last couple of days, right? You're down anywhere from 0.25% to 0.5%, and we end the day positive by some decent amount over the last couple of days. It's like this continuous pattern. Same thing happened today. Not as much to the upside. NASDAQ, again, only up 8 basis points. This is kind of similar to yesterday. Dow Jones ended up 0.2%, a little bit of a reversal. Dow Jones weighted down yesterday, obviously, by UNH. UNH, opened somewhere around close to 280, got as low, maybe in the 260s, got down to 240, ended the day at about 275. I'll talk about that one just a little bit. Raise your hand, classmates. Raise your hand if you couldn't help yourself but to YOLO into a United Health position today. I'm one of those people. And the Russell was up 0.5%. The VIX volatility index, my babies, 1783. I almost can't believe it. 1783. It's a cold game, bro. This is the linear thinking, 5 weeks ago, it is 60 VIX. You talk to somebody, and they were linearly extrapolating those events, and the story that they would have told you was the story of 5 weeks ago linearly extrapolated out over the next 3 months. They would have told you that in a very short period of time, your store sales are going to be empty, that we're headed into a deep and painful recession. It's not just some people in the comments, man. This is Goldman Sachs and JP Morgan I'm talking about that fall into this same trap. 5 weeks later, you're out of backwardation. Bonds are at 113. Gold has come off of its high. Bitcoin's still above 100,000. None of that shit made sense to the person who is linearly extrapolating the events of 5 weeks ago into the future. But here we are. VIX at 1783. Vol term structure has completely normalized. And now, I get the distinct pleasure of coming in here and probably being wrong for a little bit. That's probably not the way to cultivate and maintain an audience, but I believe it is going to be true to a slight extent. So I think when people come in here, they're not going to hear a super bullish story right now from me. I'm going to explain that matters, right? Because every day you come in here, I imagine, you just want to share people's points of view, express your own and hear other people's. At 5,900 and change, there's individual stocks, United Health being one. I might take a small individual short-term bet or longer-term bet, start to create a longer-term position. But I don't see a ton of value here. I do see the opportunity for additional positive news headlines, and in the absence of substantially weaker hard data, this could be a headline-driven market all the way up to 6,000, and who knows beyond that. But I don't see a bunch of risk and reward here. So here's what happens. In this moment, it's the guy who's saying this shorter term moving average is above this other moving average. He's the one, or she's the one, that's going to stay in market here. They're the ones that are going to continue to take upside risk, and they're not really going to change their opinion until you get the roll, right? Until this thing gives up 3% in a day, and then they go, okay, I'm out. So I'm not overly. I told you guys I'm not overly bullish. I'm not overly bearish. I just don't see a play here, and I could see us being a bit extended and giving up a decent amount back to the market. I could see hard data that starts to come in a little softer. Or much softer, but I could also see the market looking through any softness in hard data. In the same way it just looked through GDP, I could totally see the market starting to look through any problems with hard data. So I'm not waiting with bated breath on some ISM number or PMI number or anything like that shows weakness, because I kind of think that's going to be a sucker's bet for the next 3 months, because the market already knows. The market already knows we pulled forward a lot of spending into the first quarter. The market already knows on a quarter-over-quarter basis that's likely not to be the case in the second quarter. I would just be careful. I also think if I had an incremental dollar here, I ask myself, at 6,000, would you be a buyer? And I'm talking about as a trader, not an investor here, right? At 6,000, am I a buyer? Not a ton. I can't see myself getting superly. I can't see myself being very excited about the price here. I might get more upside. There might be another 100, 200 points. Who knows? Maybe more. Maybe we've completely changed the dynamics of how to think about this market. But because I know myself, it's easier for me. This is the wildest thing. It's easier for me to push the button when everybody's freaked out, because I know I'm getting a better equity risk premium, a better number there, a better value for pressing the button. When everybody's chill, bro, I know I'm not getting a good price. It might go higher, but I know I'm not getting a good price. What a beautiful term structure. Can you believe it? Can you believe it? You know what I totally underestimated? I felt I had a decent read on the U.S. administration and their incentive structure. I think I said something on April 3rd. It's like you're either headed for war, this is headed for hard conflict, or you're headed for a deal. And this guy has made campaign promises. He doesn't want conflict. It's not going to reflect well on him, and his base is not going to go along with him. It's not what they voted. So you kind of know what the incentive structure is. They have to do a deal. The only question is, how much pain are they willing to take before they do that deal? But what I didn't fully wrap my mind around, and I'm really thankful for people like Michael Cow, who's at Urban Cowboy on Twitter. What I didn't fully wrap my mind around was China's incentive structure to do a deal as well. And so Yeah, I thought the back and forth, the tit for tat between the U.S. and China was actually going to drag on for longer than it did. I know we're still not out of it. In fact, I think there's more of this back and forth in the negotiation. I don't know if it ratchet up tariff expectations go up higher. But if the rhetoric between the U.S. and China turns sour, who knows how that changes how to think about risk in the market. But yeah, I didn't have a good handle on the Chinese incentive structure. But luckily, there are smart people like Michael Cow who helped to elucidate me on things like this. Hold on, let me pause for a second and see what you guys are saying in the chat. TDS vol panic with MAGA vol suppression rally. Yeah, unfortunately, you know what's actually, son, I think it's actually probably a good thing. In a weird way, a bunch of people, they probably got taught a lesson in this first 100 days. It's the same lesson that I think a bunch of people learned in 2016. But I think the scar tissue wasn't there. And so a bunch of people are going to be a lot more honest going forward. I can already see it. I can already see a bunch of people who kind of over-rotated, and I think they're going to be a lot more neutral going forward. And I think that's a good thing. And number two is I think it's a lot of people. Like I see a bunch of names here that aren't here anymore every day. And it's unfortunate, and I miss those people, and I wish them the best wherever they went and wherever they go. But there are a bunch of people that came in here and they straight lined what was happening 5 weeks ago. And they were certain of it. And anyone who had a differing opinion from them in this chat, they would undress them. They would talk about how unintelligent they were, how they couldn't see it. And unfortunately, those people probably had to deal with two things at once. They had to deal with a portfolio that probably got absolutely smoked, and probably an ego that's searching for answers right now. And this could have just as easily went the other direction, right? We could have been at 4,900, and a month later we could be at 4,200, and I could be thinking to myself, what did I get wrong? You know, what did I get wrong in what I was seeing? But it didn't go that way, right? I don't know. So I don't know if maybe we just got lucky. Survivorship bias put us on the side of the coin that, got a little lucky here, or maybe, just maybe, sort of a bit more neutral stance, a bit more objective stance, and trying to understand the incentive structure of the world around us, instead of leaning into straight line thinking. Perhaps that helped us through a really weird, ugly, nasty, very unpredictable time where the distribution goes wide. And I'm not so certain. Everything tells me that we are through the woods, right? 6,000 in the S&P, VIX term structure normalized, bond vol down, VIX at 17, MAGA 7 rallied hard. Everything tells me that sort of this has turned the corner into something new, and I'm sure we are into something new, but that new sine wave that we're on doesn't necessarily come without volatility too, or without the potential of a left tail move. So I don't want to get too, emotional in either direction. I'm totally unemotional about this, man. We're just looking for opportunities, and opportunities come in other people's linear thinking, honestly. Let's see here. Let's get some more of your comments. UNH, so you guys did jump in. Learn D-chat. I think this is very important. Sometimes I want to show you guys something. What's cool about being on Twitter and, having a few people that follow me is it becomes sort of this interesting contra. When I say something that everybody likes, I go, this is probably wrong. And when I say something that everybody hates, I go, there's something worth looking into here. This is probably directionally right. And that's not always true, and you have to be careful with it, because that type of thinking can just lead you to doubling down on bad ideas. All right, get this out of there. There you go. But I said this yesterday. I go, UNH is the type of company. Oh, no, this isn't the one. But it is true. UNH is the type of company that will disappear a whistleblower and a key witness. That's my long investment thesis on UNH. Joking. Where is the... Oh, yeah, this is what I said. I said, this is me buying all of your UNH tomorrow. And it got a ton of engagement. A ton of people liked it. And I was like, uh-oh, this is not the bottom. This thing's going lower. And that's okay, because I just started a very, very small position. And I think this could get ugly. But that's kind of the whole thing. That's kind of the whole linear straight line thinking, right? This thing is down 50%, could cut in half another 50%, could get even worse than that. So I start to, I think a couple of people are like, buy it at 220, buy it at 180, and that will be very smart. It will sound very smart if we go down to 175 and rally. It won't sound as smart if we go down to 125. And it won't sound as smart if we never get below 200. And because you don't know, my whole thing is, if they're going to give me a massive discount, I'm going to start accumulating a position. Now, this could get so bad, not because of the fraud investigation and, the potential for Congress to make United Health Group like this scapegoat of just gigantic fraud throughout the industry, in the same way like Purdue Pharmaceutical. You think Purdue Pharmaceutical was the only person hawking opioids through that whole period of opioid pandemic? They pretend to do something about the Sackler family. They make them sacrifice a couple of $1 billion in their wealth. The rest of it's sheltered somewhere. Nobody goes to jail. But it does seem like they're gonna make this. Somebody's got to pay the sacrifice to the gods here. You get one scapegoat to make the pitchforks happy, and it seems like UNH could be that company, and it could be. We could get massive reform to the PBMs. And if all of that happens, 275 is not going to look cheap. Well, we don't know. And that's the whole point. But D-Chat says, learned my lesson years ago with Tyco and others. UNH is going lower. And the reason I think that's I want to say this very clearly. I start my position in UNH with that mindset that it probably is going lower. And that's why I start my position small and I build into the accumulated size that I ultimately want. It's called just diversifying your entry point. I don't know where it goes, and I very much believe the potential to go much, much lower is there. But today, at least, I'm on the hook for a couple of UNH deltas. Grumpy Mike. All it takes is a tweet. Soul Train says, Vic, they said recession, not deep, long recession. Love the point, but I think that's true. I think some said regular garden variety recessions. Some said we're headed for a deep, painful recession. Some people straight lined out to the 1930s depression. I mean, I'm not saying that was the average of what people were saying. It was probably the exception. Shout out to Trading Places. What a movie. I'll do a couple more here. We'll keep moving on to bonds. Tasty Live Victor, thanks for sticking up for us this morning with Tom. That was fun. That was every once in a while, every few months we do that boomer millennial discussion, and it's fun every single time. It's fun. He knows. I think parts of him, you know, he'll say that stuff. Just because he knows it gets under people's skin, you know. And if every other business owner would say, I'm not gonna take an adversarial position against the millennial because it will negatively hurt my business, and he goes, no, I'm gonna piss him off. I'm gonna piss him off a little bit. Like every other person is trying to go after the what's the word for it? Not yet rich. What is it called? No, I can't remember what it's called. But it's basically the millennial high income, not yet rich, right? Henry or something like this. They're trying to go after that segment. Meanwhile, he's being like adversarial. But he's a genius at creating engagement. He doesn't mean it. He knows you guys are out there slanging him. I'll do a couple more here. Son, that line, TDS vol panic with MAGA vol suppression rally, that is so genius. Catan says linear thinking. Black-Scholes was made on linear thinking. Sort of. You'd call that? I don't see. I kind of get what you're saying, the concept. And I do think. I never thought about this until I read Nassim Taleb. Is it Taleb or Taleb's book, Black Swan? I never really thought. This has been a long time since I learned a lot of this stuff, you know. And I suppose I knew this, but in the book, he talks about how, you know, all of these risk desks are basically, we have all these complicated risk models. And at the end of the day, we've sort of forgotten that they're all based on these gigantic assumptions. That as fancy as the math has become, at its core, this was only a model to attempt to explain reality, and it is not perfect. It is an imperfect reflection of risk. It's the best we have, but it's imperfect at its core. And I thought it was a really good book, but that was the thing I took away most from that book. It's probably not the thing that most people took away. But that, for me, that concept still sticks in my mind. Oh, and I think that's what you were talking about, Catan. Yes, I see it later. I guess that's why long-term capital, I think you meant, long-term had that event in the late 90s. Yeah, he talks about that in that book too, actually. That's one of his points. Oh, this is a good one, and then I'll move on. Theta Trader says linear thinking, but also people demanding you think in black and white terms too. You must have a strong opinion on any issue or people are pissed. This is the truest thing. And it's a gigantic red flag, you know? And you see it a lot lately, and it's really, especially on the internet. The thing that I love about markets, and when you talk to people in markets, I don't need, and people are used to this because in their everyday lives, there's a lot of debates. And when you're in a debate with someone, and people do this on the internet, they want to win. They want to win the argument. But in markets, it's like you can have your opinion and I don't have to agree with you. And I'm going to put on my bet, you're going to put on yours. And the markets are going to prove us correct. I'm not going to sit here with you and tell you why you're wrong and get upset that you won't agree with me. The markets are our outlet to express the opinion and just move on. And so what I find interesting sometimes is a market participant that cares more about you demanding that you accept their opinion. That person's on tilt. That person's probably on tilt because nobody cares. If you've been doing this for a while, I could care less. I'll listen to people here all the time, and they have a completely different point of view, and I go, okay, we'll see. You know, when I say, or you take the over, the under on 4 cuts this year, back a few weeks ago, some people said the over. I go, oh, that's interesting, and they laid out their case for why, and I said totally plausible. I'm going to take the under. Here's why. We'll see what happens. And you move on. Demanding allegiance to your ideas. It's a thing that the internet has created and sort of nurtured and encouraged. And I think one of the greatest things about markets is it helps you avoid all of that stuff. My wife asked me the other day, she goes, hey, do you think I should start trading? And I go, no matter who asks me that question, no matter who they are or what they do, how old they are, how much money they have within a reason here, the answer to that question from me is always yes. And it has nothing to do with making money. It has everything to do with helping you understand who you are, what you're afraid of, what you want, what your deepest desires are, how to mitigate against that emotion when it comes to decision making, how to learn to make decisions, quick decisions, how to measure risk and reward against each other, and have a probabilistic outcome of expectations. I think trading makes better people, as crazy as that sounds. If you're lucky enough to find a place who are like this, who are thinking about trading in terms of probability distribution. If you're in a place where people are tarot card readers, and I'm going to give you my levels and all this other stupid shit, you're probably going to do some damage to yourself. But if you're in a place like this, that's thinking about the world in terms of probability distribution, I think it makes you a better human. I think it makes you a more informed citizen. I would never say no to that question. And then we opened an account. She lost 30% of our net worth. No, I'm just kidding. I'm just kidding. Bonds, my baby's at 113 and a half of a point. We got a little rally today, huh? We got a little bit of a rally. Is it a head fake? We're back at those 111 lows earlier today. And what did we get? Something like a point to the upside. Not necessarily, but a decent little rally today. Do you believe them? Is anyone out there like me crazy enough right now to go long the long end? Because everybody out there is saying, and I'm probably just I get absolutely murdered. I'm telling you, I think I'm being too cute on this trade, but I can't help it. That's why I'm doing it really small. But what's supposed to happen now that all the risks have dissipated, what's supposed to happen now is the long end lifts because the market starts forecasting growth and inflation. That's what's supposed to happen. Nobody's, as people's recession calls dissipate and they don't see recession as their baseline right now, and they move it out of their distribution over to the left tail. What's supposed to happen is they're supposed to take more risk. They're supposed to sell bonds, and bonds have to find a higher yield in order to attract capital away from risky assets back into the bond market. That's what's supposed to happen right now. But some part of me, again, this is the too cute part of me, thinks that a lot of these deals could come with sort of this tailwind to restored confidence in the dollar as the global reserve currency, because that, in some ways, 5 weeks ago, people were even questioning that. as the bonds as perhaps something you might not need to be as fearful of as an asset in your account. I don't know if that's true. But I do think, Michael Cowell put out this, I think he used AI to go through this $600 billion investment commitment in Saudi Arabia to basically distill it down to these key points. I'm not going to read all of them, but at the top line, I think this is really interesting, right? The total investment, $600 billion Saudi commitment to U.S. assets. And what's so interesting is when he went out there, he labeled it as, he's trying to get $1 trillion in his Middle East trip, $1 trillion of total capital. And he got $600 billion in a chunk. The bullish implication for the petrodollar system, I thought this was a brilliant way to lay this information out. But major USD recycling, sustained demand for U.S. financial assets. And I think that's the right way to look at this. So this is $600 billion. He wanted $1 trillion out of all these visits. I think we'll get new trade deals that come in. And so some part of me thinks that maybe the right way to look at this as we go through and make these deals are about restoring confidence in the in sort of in a place in the U.S. financial system, in a place where maybe 5 weeks ago, a month ago, maybe even 2 months ago, the market didn't necessarily have that confidence. I don't know if that actually matters. This is the biggest thing. I think I might be too far out on a ledge talking narrative here. There might not be enough there when all is said and done with these deals. And what might matter more is that the budget that's being put forward is, what's it, 6 trillion, something like this, of potential deficit spending. That might matter more, and we see the long end lift. We shall see. We shall see. The twos I'm out of too. And you can see on the curve, let's take a quick look at the curve. We went from a flattening 65 basis points. We came into about 47 to 48, 47 or 46 basis points. We flattened a little bit. And the last couple of days, you added 2 basis points to that. So at least in the very, very short term, some of that move seems to have ceased, that flattening. In the Fed funds futures, not much has changed from yesterday to today. A lower probability, though, in July. They are really taking those things off the table. June is clearly off the table, at least as of today. July is off the table as of today. It seems like they've baked in September with a 50-50 in October, and then pausing in October and December. Absolutely wild. It's wild how fast that happens, isn't it? Just 2 weeks ago, recession was in the middle of people's distribution. It was their base case. We were talking about 4 cuts. People were certain, some people were actually betting that we would end up needing more cuts than that in 2025. And now we're talking about 2. And even those 2 are kind of iffy, with October being sort of a month that they may pause and wait a bit. And then who knows, once you pause, once you pause, it's always possible that a 1 month pause turns into a 2, turns into a 3. I am absolutely fascinated by how quickly that picture changed. It's one thing for equities to turn around. because that's what equities do. It's another thing to see this fast of a repricing, a changing in the pricing of the policy path. And what changed really, you know? What changed? And I talked about this with Chris yesterday. I talked about it a little bit with Tom today. I think sometimes a retail trader has an edge. Sometimes a retail trader has an edge, and this is what no one will ever say. Very few people go on television and defend the retail traders in the way that they deserve to be defended. There aren't many. There are people that go on TV and they do make a case for retail, but they don't do it themselves. They don't press the button. They're not balls deep in all of this stuff. So they don't make a great case. You know, they're not the greatest representatives. But in this particular case, if, you know, a institutional trader comes and he gets tapped on the shoulder and they say, hey, you need to puke that position, or you need to deleverage, you need to degross, you need to take your positions down. And you may love your position and you may know that he's got to make these deals. It doesn't matter. You know, you need to take your position size down by X dollars or X percent, and you just got to do it. Whereas the retail trader maybe is going to take more variance, more swings in the portfolio, maybe not, depending on how they trade, and they can hold their position a little bit longer, assuming they're not massive, they're not on leverage. And I think this is one of those times where the retail trader had an edge. It paid. Not only did they use the edge, but they bought into it. You know, they bought, what did you crazy degenerates buy? You bought like what was the number? You bought like $5 billion on April 3rd, something like that. Then you were buying crazy triple leveraged long stuff after that. I saw all these reports from Bloomberg. People are buying crazy triple leveraged long ETFs. And then at the end of the day, you guys got paid. You know, you take a little bit of risk. You don't think linearly, extrapolate today's actions and activities, today's fear out into perpetually into the future, and you get paid. Congrats to all of you. This is the other thing, is that this curve is not really changing, man. This has been a pretty boring trade, and you can tell when our opinions are changing. 114, 113, now I want to get long. 117, now I'm lightening up. You can tell like the ranges for how we're talking about, thinking about trading bonds, they're shrinking. They're getting smaller and smaller on a directional basis. You know, vol spiked for a little bit, and you could sell vol and get decent premium. That's not always my game. But and you can tell that not just in the individual instruments, the tenors themselves, but just the whole curve. We had a bit of a flattening from 65 to 45, but it's just grab a Snickers. We don't seem to be going very far. And I read this today, the higher for longer. You know, how many of you thought that higher for longer meant like, what are we, 3 years into this? Huh? I know they've cut a bit, but like, did you think we'd be still at these kind of levels 3+ years later? I did not. Higher for longer did not. I had no idea. And we're only talking about 2 potential cuts. I guess if I could ask the question to you guys, the question at the very beginning when they were raising rates is where to raise them, because we knew they were going to raise them somewhere, stick them, and then keep them there. And if you go too high, then you create a lot of pain in the economy too fast, and you risk a credit event. If it's too low, inflation becomes entrenched. You don't have stable price increases to the upside. You're going to get a bunch of rabble-rousing people in the streets. So it's important that you try to stick that number as best as you can. And I guess in hindsight, given what you know right now, which is not full and complete information. You probably need another few years to really make and maybe even a decade to make that call. But as of where we stand right now, 5.25. Did they make a good call? Do you guys think 5.25 was a good place to land and then start sort of changing policy from there? I'm curious. You know, people at the very beginning, when they stuck them at 5.25, they would see stuff like, Fartcoin going up by some crazy amount, and they would make the meme. They would make the joke, jack rates to 8% now, or jack them to 10% now. What do you think? Sleep, you buy puts and calculate your lambda value. Bet they won't cut if gold keeps ripping. Explain that. Explain that, Trev. Donaski said, yep. Donaski says 600 billion from the Saudis and 300 or 400 billion Boeing aircraft order from Qatar equals roughly $1 trillion. How about that? Boeing has been an absolute sick, such a sick move. They shouldn't cut until stocks get cut in half, says Son. I don't know about that, bro. If you're not going to cut until stocks are cut in half, why not just Volcker this thing? Why make it slow and painful? Just get it over with. I don't get the logic there. I closed out, as I said before, God, I got lucky on this thing. I closed out the euro. It's had a little bit of a rally over the last couple of days. So I've got nothing here. No, it's very rare that I'll take a position in a currency. And if I do, it's either the yen betting on increased volatility, or it's the euro. I want neither parts of either. I'm still leaning a little bit long Bitcoin here. The miners are starting to get cheap again. Make miners cheap again. The gold doing, nice little, weird little rally here today. Good for Ilya, I suppose, but I think maybe good for Chris as well. I can't remember. I think he's a little bit long here. So good on them. I've got nothing on in gold right now other than those long miners, which we collared up, and a little bit of a recovery here. I don't know if they got cheap enough to want to buy some more. So I haven't. I really wish they would just murder this one. Can you do me a favor? Can you guys just get in your Reddit chats and spin up a gamma squeeze to the downside on Palantir? You all go raid this thing with downside put buying, and and get this thing down back to sub 100, please. You know what I think is more likely? I think it's more likely that, and if we might be there. I don't think they were there just yet. I think we're more likely to get to a price that I want to short Palantir before we get to a price that I'm able to buy it again. I think that's probably the case. I'm probably going to have to short it before I buy it. And I try to think about the scenario. Where what would hurt Palantir right now? Like, is there a tweet? Is there a piece of legislation? Is there a war escalation or de-escalation? Is there what is the thing that, other than price alone, right? Other than the cure for high prices is just high prices. other than sort of the sudden realization that the valuation is too high, what is the thing that hurts them in terms of either headline or legislation risk? Vic, do not fade me, bro. Thought we were brothers. What's your position, Soul Train? I can't remember what it was. Were you the yen? Do you have the yen position on? I'm not fading. I told you I got nothing on. Believe me, I've tried with the Palantir puts. Alex Karp's footprints are all over my back. I would never. I said this before. Sometimes you get companies, and I could be wrong, and I just go, I'd rather be long than short. And I don't know that I want to be short here. Palantir could do this thing that Rivian did. Right? There was this moment in time where Rivian was worth more than Volvo, and it had made like a couple of thousand cars at the time, and Volvo makes millions of cars a year. And it was basically at a time just after Tesla had just taken off and gone on this massive gamma / short squeeze when they were added into the S&P 500. And so it sort of seemed like this giant Me Too trade. People were trying to buy any EV, direct EV exposure, and just hoping that would be a cheaper alternative to buying Tesla, which had already made the move. And so they were just buying anything, you know. What was the guy's name? What was the hydrogen guy? Went to jail, just got pardoned by Trump. Trevor Milton, got taken down by HF. You know, and then this one was another Me Too thing. And then at some point you go, I'm shorting this. This doesn't even this is a good company. To be worth more than Volvo right now makes absolutely no sense. I suppose Palantir could get to that level of pricing. Who knows? Maybe we're there right now relative to their own revenues. Chris he wasn't saying to short it, but he was making that case the other day of what they're worth relative to their revenue. But that's what always happens when you have an explosive growth company. When you have an explosive growth company, the valuations are going to go crazy. And if you're a value investor, most of these explosive growth companies are never going to look interesting to you. So you're always going to miss out on these things. So every once in a while, you got to put tape over your eyes when it comes to valuation and a unicorn bet. I just don't know what happens. Ukraine resolution, Gaza resolution, Iran resolution, which you're kind of seeing some or a lot of that already. Is that necessarily net negative to Palantir? I don't think so. They're not like a pure defense company. Palantir risk is government and AI. I don't disagree with you there, Bobby. But again, that's probably where it is. If you start to see the administration talk about a decrease to defense spending, and that was whispered a while ago, and that created some negative price momentum for Palantir, I think that could hurt. That ended up not being the case. Defense budget is not really being cut in any meaningful way. Captain says Palantir will win if it's always in people's mouths as a positive. Son says M2 is cooked. You're a monetarist, son. M2 is cooked. All this froth is going to circle the drain. You don't need a stock-specific reason for portfolio. That's actually a really good point. That's probably the best point. Do you follow Steve Hanke, son? he's probably the one guy I listen to the most when it comes to thinking about how maybe sort of that group, that world thinks about M2. To me, that guy's the only one making sense, and nobody thinks that way anymore. Nobody speaks that way anymore. Everyone thinks M2 doesn't mean anything anymore. So I think listening to people like that keeps me sort of grounded in reality. Everyone else doing these weird equations to explain what's happening in the world. I'm like, bro, just like, we need to go back to gold. We need to go. But when you're, I don't know which one of these two things is true. Either the monetary system has become so complicated, you can't know it. It's unknowable. It's this beast that has become its own beast. Or it's actually really simple, and everything else is just there to make it seem complicated. I sort of think the latter. I think it's actually pretty simple. I leave room for the idea that that might not be true, but it's probably my preferred mental model. That money is actually relatively simple, and we make it seem complicated, but it's simple. It's always been simple, and it will always be simple. And the only thing that changes is the distribution of that money, and the distribution of the money changes how the game is being played, because it changes the game theory or the incentives of game theory within the game itself. So you change the distribution, you change the way the game is played. And I don't actually want to talk to Tom about that. When it comes to efficient market hypothesis, I do think that the way I think about price changes if you tell me 90% of the wealth is in 10% of the hands, and those 10% all know each other. They went to the same schools, they live in the same neighborhoods, and they all have similar vested interests. And I go, okay, well, that's going to change the way I think about how they'll play the game. Right? Because if that distribution gets smaller and smaller and smaller, the smaller that distribution gets, you go from 10%, 1%, a couple of thousand people, a couple hundred people that happen to see each other when they go to Davos once a year. And then I go, well, in Prisoner's Dilemma, what happens if all the sharks that are supposed to be competing with each other, what happens if they stop competing? How does that change the way I should think about price? How does that change the way I think? If a small group has acquired the claim on future resources in the hands of a very small group, and if they compete, this is the way I should think about price. But if they stop competing, if at some point they go, you know what, we'll have a better outcome amongst ourselves if we start some level of cooperation amongst us, and the group is small enough to do that, then how would that change the way you thought about the game? How would that change the way you think about price every day? Mark, that's a really good point. You just described FinTwit. It's all the same people shilling their Substacks. All the same thing, and then they go on each other's podcasts. They are all clowns. If they were so smart, they wouldn't have to shill subscriptions and would be on a beach. In fairness, Mark, a lot of those people are on a beach somewhere. There's a part of me that sort of, people say that a lot, if you were so smart, you'd be on a beach. I think a lot of those people were so smart, they stopped working for somebody else and they trade for themselves or their own family office. And when you trade for yourself or your own family office, it's really, really boring. it's really boring. It's 6.5 hours a day minimum staring at a screen by yourself. Most people don't do it for 6.5 hours. They're looking at futures, and they're looking at currencies. And when you do that, Twitter comes along and you start to express your opinion. You start to read other people's opinions. You create this community of people that are doing the same degenerative activities as you are, that care about the subject matter that you care about just as much as you do. And you guys, you know, there's a value to what you know. And if there's a value to what you know because you've been doing this for 15 years or 20 years, or you're in an institutional position, or you're a PM, and there's value to what you know, you're monetizing it every day in the marketplace, and there's an additional monetization. I don't sell subscriptions. I've never done it. I'm not knocking anybody that has. But I think, you know, monetizing your own knowledge, I don't always think that that's a red flag. You know, there's a lot of people's minds that I get access to for free on Twitter. And then there's a lot of people's minds I might pay a little bit to get their more deeper, nuanced thoughts on subject. And I feel it's a fair exchange. I feel that the money that I exchange for their time and their point of view and perspective is worth it. Do I think by subscribing to somebody else and paying them a couple of bucks that I'm going to somehow get rich by following their calls? No, because that's not the way I look at it. I want to know how other people are thinking through problems, because I'm deathly afraid of my own confirmation bias. I'm deathly afraid of the Dunning-Kruger effect. I'm deathly afraid of many of these types of things. So getting access to the way other people think about problems, it does have a monetary value in some cases. That said, I think you're 100% right in pointing out the groupthink that happens in certain aspects of FinTwit, but just in algorithms in general. I agree with that. All right, let's keep cruising here. Still no position on crude oil. You know, still none on energy at all, other than just getting long energy stocks as they get cheaper and cheaper. You know, people were calling for the $50 oil, which I can understand. I'm seeing calls for like $40 oil now, and I don't know about that. I don't know that I'd put that in the cards. 50, okay. And we even got down there. We touched the number, not for long, but I can totally get that. $40 oil? That would be wild. If we get to $40, I miss my damn car. I moved out to Singapore. I'm not driving. You guys, if they get crude oil back down to $40, I'm going to be so pissed off that I don't get to go drive around for next to nothing, paying next to nothing in gas. Not getting paid on silver. Didn't get hurt today, but not getting paid. I think this is going to end up being a lesson to me. It's like, if you have an opinion, and that opinion is gold will increase in relative value relative to gold, that the gold, I don't know why I said it that way, that the gold silver ratio will go down into the 90s, then just play the gold silver ratio. Don't try to get cute because you got greedy and now you want to buy upside silver calls because you'll get more money trading it that way. I think this will end up being a lesson to me, but I'm still long silver. We'll see what happens. Let's see. The degenerate trader says most people subscribe to copy trades. All you have to not reading the rest of that. I don't know. I've never understood. I think I just have a really big ego, you know, and I'm very competitive. And I think this whole game, part of it, the kicks for me, is I want to match wits with other people. So to me, every day I sit down, it's a game of matching wits with the market. To me, it's a competition of ideas. You have a set of ideas, somebody else has a set of ideas. The market is thinking one way, and the way to make money is to envision an outcome, and not many people agree with you, and that outcome becomes true. And to me, that's I love the thrill of that competition. And then that competition also comes with sort of a monetary reward. And then depending on how you structure the risk and reward and the heat that you take en route to being right, if you're right, also that's part of the game. And I love everything about this, man. I love the competitive aspect of it. And I think doing this just to copy somebody else's idea, I don't even get that. I don't understand it, because the part of coming up with the idea, of expressing the opinion, of then coming up with the trade construction that matches, and then playing the game, going in the arena and playing the game. That is the whole thing. So what reward? I mean, I get it. You know, some people just want to see the number go up. But to me, this is the game is so much deeper and richer than that. You know? And copying somebody else, and if the number goes up, I just go, what do I did? I didn't learn anything. And if this person leaves, I'm screwed. I need them now. Especially in the middle of a trade. You open a trade that somebody else put on. What are you going to do? What if they go on vacation? What the hell are you going to do then? Let's see. Oh, Mark Bender is just throwing heat today. I'll do a couple more. Well, I've got a few more topics to cover before we get out of here. Human nature. I'm going to read some more of Mark Bender because he's on fire. Human nature is the only thing that matters. It always repeats. Amen, brother. Markets can only go up because that is human nature. We all look for the positive and always move forward. Okay. Where's the rest? It just disappeared on me. Wait, that is completely wrong. Thinking you just described mainstream media because they glorify that dude who called the GFC in 2008, Michael, whatever his name, Michael Burry. I think that's who you're talking about. Yeah. But again, like, as long as you get to places like this, then you go, oh, that's survivorship bias. That's why that guy's on TV. And I see what that is. I understand it, even if other people don't. And, you know, it's not a big deal. That goes back to what I said before. You ask why you're seeing something. If you always ask yourself, why am I seeing this? And you can answer that question at a deeper level than other people. You have better context for framing. And I think, in a way, you do this long enough, you don't have to watch the news anymore. You know, the number is your news. And you know, to a large extent, and I get what Tom says when he says this sometimes. You know, I get why all those floor traders, they go, I stood in a pit and I could tell you what the news said based on how the number moved. I understand that point of view and perspective. There was a time when I go, I don't get that at all. How are you not glued to a screen somewhere? But I get it. All right. A couple of more topics. Here we go. Not a bunch of the data today, at least to me, was sort of rather boring and uninspiring, retail sales especially. I'm not sure what Ilya has to say about it, but to me, I don't think there was a ton here. Consensus at 0.1%. Maybe the core was a touch light. But to me, I think retail sales is one of the worst reports. Non-inflation adjusted retail sales. I think it's one of the worst reports that comes out, especially in a world where everybody's trying to understand inflation and its impact. You can't do much with that. The housing market index was another interesting one, though. 34 versus 40, very quietly. And this has happened. We've seen this flattening in the curve. We've also seen very, very quietly a little rally in the home builders. And a significant one at that, from 85 up to 100, $15 rally. So, my babies, the question here, is it time, to use a Lion King reference, is it time to start building some positions in these home builders, or is it too early? And I think if you tell me you think long end rates are going to 6, then it's way too early. It's too early to buy anything. But if you tell me we might get a rally in the long end here, a sustained rally in the long end, maybe for the next quarter, then these start to become interesting. KB Homes, Pulte Homes, Lennar. Some part of me really wants to start nibbling. But the problem is you just can't look at these home builder charts on a 1-year basis. You almost have to look at them on weeklies. Because they went on a 2-year rip. There's a straight 2-year rip. Everyone, in 2022, when rates got jacked to 5%, these things went to the floor. And then it went on a 2-year rip. So if you only look at a 1-year chart, you're going to miss probably half of this move. So you have to look at a multi-year chart, and you kind of have to put these on weeklies. It's not the worst price. $60 to 180, 120, 60, 120. We're just under mid-range for this whole move. Let me see what you guys are saying. Is it too early? Son says short gold calls against silver puts. That's interesting. Son says anything housing related is going to go insane. You buy housing against tech shorts, long end rates are going to 3. I think that's directionally right. I don't know if it happens like right away, but Son, I think that's 100% right. I think it's just an inevitability. I don't know how we get there through natural market forces, whether it's yield curve control. I don't know how it happens. But I tend to agree. And that's why I keep looking at these things. That's why at first, when they started cutting in September, I thought long end rates are going to lift, but it takes forever for home prices to move. That's going to create less of home affordability. These things are going to drop. But I also think this game ends. It always ends the same way. And it's going to end the same way here. How much time is it going to take and how much pain to get there, I don't know. But I agree. I'm watching these not because I want to bet against them. It's because I'm looking for the right time to start betting on them. Yesit, if I'm pronouncing that correctly, I hope I am. If I'm not, my apologies. Do me a favor and send me the phonetic spelling. But Yesit, I appreciate those very kind words. That's my point. Once you follow these FinTwit, Mark Still firing. Once you follow these FinTwit dudes for a few years, you can stop following all of them because you realize they all basically stick to their own themes that don't change. I would say not all of them. I think there's a handful. I think there's a handful that I think are much more dynamic in the way that they think. I think there are a few that you have to be careful about understanding their incentive and sort of frame up their points of view alongside their incentive. But I think there's a lot of valuable opinions out there. It's like, I'm going to give you an example. Look, the people, the guys in the logistics that 2-3 weeks ago that were on Twitter talking to each other logistics people and explaining the situation in logistics, were just explaining what they saw on the ground. And their opinion is valuable because they have the subject matter expertise. But people take that and they extrapolate it out to something else. They extrapolate it out to the grocery stores are going to be empty in 4 weeks because the time it takes these containers to get from China to LA is 30 days. So you have 4 weeks past Liberation Day and store shelves are going to be empty. It's like, well, you took some good quality info, you added a bunch of assumptions on top of it, and you turned it into a bad output and a bad expectation. And there's no understanding that, there's a guy that's also political pressure. If I'm running logistics and all of a sudden my business drops 40% and I've got a big platform, I'm going to use my platform to push this issue up towards the top of people's email inbox. And that you have to understand, that there's a political play there too. And I just think sometimes people take stuff and they don't frame it correctly. I don't think it means the original information is of little value. I just think it has to be framed correctly. The person's incentive structure who put this thing together, this piece of information to you, has to be framed correctly. All right, I'm going to move on. Well, I'm going to go to my last topic here. If you guys throw me some symbols that you guys have found that you think are interesting for whatever reason. I do this very rarely, but I find sort of the stuff that I'm looking at, it's very, I haven't been exposing myself to a lot of new ideas lately. Outside of sort of the ballpark that I stay in. So I'm sort of curious to break my own sort of little bubble that I've been in and ask you guys, what other symbols are you looking at? What industries are you looking at? What themes are you looking at? Who's with me on this? Who's with me on this home builder play? Who's chomping at the bit? And the other thing I don't know is if it's is it home builders or REITs that I should be looking at? If it's on the REIT side, the REITs have kind of already moved. Sorry, I know I'm being quiet, but this one I hadn't prepared, so now I'm trying to do this in real time. Just going through a handful of these REITs. Now there's way less volatility in these. I don't know. I'll have to decide here. At some point, I want to pull the trigger. I think I actually did buy a little bit of XHB. Not much. I think that's not probably the right play. Meaning, it's not that it's not the right play. It doesn't have the most leverage on an individual dollar. It'll probably make more sense to buy individual home builders or individual REITs versus baskets. Is this thing public yet? No. I'm telling you that I want to buy the prefabbed homes so bad. Every part of me wants like Boxable to go public right now or something like it. I can't find a good pure play exposure on prefabbed homes available in public markets right now. And I want it so bad. To me, I go that's just this one of these ways you can just politically, somebody's going to come along one of these days and just say, we're going to use government money to build a bunch of houses. Because I don't think any trader, if you ask a trader, you said, okay, you've got an expensive asset. How do you get the price to go down? And is it help with the down payment of that asset, or is it to tax the asset more? And perhaps not as intuitively, you don't really make homes more affordable by offering more money for the down payment. You're actually going to make it less affordable. So the way you make homes price go down is you increase their price, really. Like you jack rates, for example. You jack the borrowing cost on homes. Now all of a sudden people can't afford them. You limit demand. In theory, price falls. So I hope, it seems, I think American people have woken up to what works and what doesn't. And I think regardless of the political landscape, if we lean Republican or we lean Democrat, and maybe this is wishful thinking, but I think people have woken up to like simple economics, very simple elementary economics as to how this stuff works. And I'm hoping that we understand that like subsidizing our problems, it's like this short-term Band-Aid that makes the problem exponentially worse just in time for the next election. And some part of me hopes that we figure that out. And I don't know if that's true, but I'm optimistic that people are coming around to these ideas, that policies that they've seen played out long enough, that people in my generation are 40 years old. They've had real-time experiments long enough to see how this stuff works, that they're coming around and they're going, oh, no. I don't want that medicine. That medicine, when I take it, makes me more sick. It makes you feel good today, but it makes you feel worse tomorrow. So what else you got? And I'm hoping that we kind of figured that out. We shall see. All right, everybody. I I appreciate everybody that threw some symbols in there. I'm going to take them away, read them in my own, and then I'll come back and I'll respond at a later time. I appreciate it, though. This is Synthetic Friday for the show, so I will see you back here next week. Same time, same place, same great network, only on Tasty Live. Good luck out there. Peace.